Good morning to our wonderful audience and welcome to the BCI Offshore Investment Managers webinar. This is the first day of a 3-day series extending over the next 2 Wednesdays as well. On screen now, the agenda for the day. Tanya and the BCI team again made for a super lineup of exceptional global managers, and we will trust you find their insights of great value. Time allowing, we will cover questions received from the audience in the Q&A box after each presenter or after each speaker. And as per usual, if we don't get to all the questions, we will circulate it afterwards and get you some feedback on that. We are recording this session and we will share a link to the recording and all the presentations on the Boutique Managers website. All eyes on the Fed later today, with most expecting them to pause, while Trump back in office talking tough and demanding rate cuts or rates to come down. Is it about what Trump wants, or is the Fed still independent? Inflation progress stalled out a bit, and US bond yields are trending upwards, causing market jitters. There are big structural changes going on away from the Fed. Introduction of the DOGE to cut spending and create government efficiencies. We've seen Trump also offering millions of federal employees packages over the next 8 months to take their stuff and go. How will this impact on employment? Intention to lower energy prices with drill, baby, drill. Tax reform and tariff discussions we've all heard so much about. But is the latter a negotiating tool, or will they really go on? Recent events of Colombia were likely a good preview of what can be expected with Trump strong arming a lot of other countries and economies. At the end of 2024, Berkshire sent Wall Street a stark warning, increasing their cash stockpile by $127 billion US. Is this a single signal to maybe rethink asset allocation and what we look for? Looking at the markets and recent drop in the prices with the likes of Nvidia and other US tech stocks, yes, they did recover somewhat, but energy stocks as well. One needs to ask if this is a potential shift in the AI landscape with the likes of DeepSeek challenging US tech as we know it. If you were underweight US equity the past few years, you underperformed. But US is trading at a CAPE ratio of roughly about 35 compared to other regions like emerging markets, the likes of UK at approximately 14. One might want to consider broadening portfolio assets to include other regions, sectors, and opportunities. Can the party still go on? These are just some of the topics and the points we will cover this morning, with a focus on fund managers continuing to find opportunities that grow earnings, ultimately adding value to client portfolios. But with all of that said, it is my absolute delight to welcome our first presenter of the day, who we're all very familiar with, all the way from London, Jared Khan, Head of Equities at Credo Asset Management. Good morning, Jared. How are you?
I'm good, Eugene. Thank you so much for welcoming me back here in 2025. I tell you what you summarized so far in the last 3 minutes is pretty much my entire slide. I felt like you've tripped the whole thing.
I'm gonna stop there, Jared. I'm gonna hand over to you. You guys are the experts. You're on the ground. You see what's happening. Early start for you as well. I believe it's a little bit dark in London. Thanks again for joining us so early morning. We really, really appreciate it. And the floor is yours. I'll hand over to you. Thanks, Jared.
All right, thank you, Gene. So yeah, just a little bit of housekeeping. We've got a bit of compliance for you to read there, which I assume you have all read in the last 10 seconds. So what are we going to talk about today? Basically, hello 2025. So 2024 was a phenomenally good year again for equity markets. The S&P finished up about 23%, and that was on the back of a very cautious economy and a lot of pundits, worrying about where things would go. If you culminate that along with 2023, over the last basically 2 years, the S&P index, and I'm focusing mainly on the S&P because I think the US, I think we've all come to realize, has kind of just dominated equity markets for the last 5 years, and that's really where the place is to be and where a lot of the gains have been made. But over the last 2 years, the index has now climbed 53%, making it one of the strongest 2-year performances since the late 1990s. And that's not to say, this is the end of it, because we've had many periods of time where you have cumulative returns going on and on and on. But inevitably, you get periods where after such big growth, there are pullbacks. And just drawing on a few of these forecasters, we have someone here from Morgan Stanley saying this is a classic textbook stuff. Two good bull years, brings a third, and then you got Goldman Sachs a little bit more bearish. The truth is, no one really knows where the markets are going, but I think there are a few indicators that we need to be very clear about in terms of where one should be positioning themselves. So the market is expensive, and I think whatever metrics you use to try and value the market, albeit PE, or whatnot, it is expensive. So here, what I've done, I've taken what's called the Fed model. It's a pretty simplistic model. It doesn't really, it's not that accurate, but what it does show you is how expensive markets are. And what this Fed model does, it looks at the relationship between bonds and equities. And here, the nominal equity risk premium in the black is the S&P index current earnings yield, which is the inverse of the PE, divided by the 10-year treasury. And what you're trying to ascertain here is the risk premium that you're going to get by buying equities. And because you can obviously lose a lot of capital in equities, you should be paid to go into equities. The black line shows you that it's actually at minus 1%. So you are paying to take the risk in equities. In other words, what we're saying is the expected rate of return in the equity market is significantly lower than what you should be getting in bonds, i.e. the market is expensive. Some will say, well, that's not a real indicator because it doesn't take into account inflation. So what we've done is we've taken the real equity risk premium, which is in the blue here, which shows you inflation-adjusted returns. And that's against the 10-year tips. And effectively, it's a little bit better. You're getting about 1.5% to take that risk. But that's not really what I'm trying to say here. What I'm saying is, if you look historically at markets being expensive or cheap, you're normally expected to get about 400 basis points of risk premium by buying equities over bonds. And we are in one of those lower quartiles, i.e. Markets are expensive, so your expected rate of return going forward is obviously going to be a bit lower. But there is some good news. The Fed has pivoted, rates are coming down, and you need to be careful of this because the market is obviously priced in for it. And basically every country in the world other than the Bank of Japan has started dropping rates, albeit the US, the UK, Sweden, et cetera, and lower rates are good for the market. Just having a technical issue, 1 second. Whoops, okay. So, whoops. Apologies. So there are still reasons to be bullish. And the one main reason is that the US economy is actually in pretty rude health. The Fed has managed to massage the index quite well, or the economy quite well, and we've had this Goldilocks environment. Interest rates, as I say, have been coming down, and we've had this AI revolution that has significant momentum. Bar what we've seen on Friday with DeepSeek, the fact is there are billions and billions of money being thrown at between Stargate and the likes of Microsoft and Facebook. There is a lot of momentum in AI, and that's likely to continue, although it may now be a race to zero, bar what's happened on the weekend. So looking at the setup in 2025, I think it's fair to say that growth is looking quite expensive. And you've probably seen this graphic before. I always put it up. It's a relationship between value and growth, and it goes back to 1974. The period up until 2000 When the blue line goes down is when value outperforms. And when the blue line goes up, it's when growth outperforms. And clearly from about 2008 onwards, growth has been the strategy to be in. And this culminated in COVID in 2010, where you saw massive extension of outperformance of value, of growth versus value, which then backtracked in 2022 when we saw rates excessively high at a quick period of time that caught growth investors. But now we're back at these levels where the relationship between value and growth is at close to all-time highs. And again, if you strategically look at where you want to be putting money, needs to be, clear of the fact that you're getting into a period or a zone where growth is looking very expensive relative to the rest of the market. And so it's very possible that you may see some kind of retracement. And this kind of reminds me of the setup back in 2021, where growth did outperform during COVID. And I use the example here of the ARK Innovation Fund. Not because anything's wrong with it, but the fact is at that time, all types of growth actually outperformed mid-cap growth, large cap growth. And the examples here of, a lot of companies under 10 billion, 33% of the portfolio under 5 billion, and upside was spread over many winners. It's different this time. Although growth has outperformed, this has been a very specific type of growth, and it's all been on the back of this AI momentum. It started in early 2023 with the release of ChatGPT, and it's just grown more and more with the hyperscalers to a point now where you have 7 stocks that we know as the Magnificent Seven that have really just pushed this AI trade further and further away and left many participants in the market behind. So just looking at the performance of some of these stocks, the S&P was up 25%. Yes, that was taken from the 29th of December, but the equal weighted S&P during that period was only up 13%. Outside of Microsoft, every other stock in the Mag 7 did exceedingly well, with the outlier here, NVIDIA, which was up 171%. And given the market capitalization of these stocks, you understand now why the market did so well. So not owning NVIDIA would have cost your portfolio alpha by about 3%. We obviously don't own it because we are more value orientated. And so hence many investors who are not in growth would have missed out on that on the benchmark. And the Mag 7 now constitutes on any given day anywhere between 33 and 37% of the index. So what have we now got? We have significant concentration, which is another risk that's come into the market. Concentration of stocks of the top 10 is not a new phenomena, but we're now at a level that we haven't seen in the past. It's normally somewhere between 20 to 25%, but we're at levels of about 35% now, which again brings warning bells just from a diversification point of view. And to kind of make this more difficult, if you're a stock picker, it just shows you how difficult the last 2 years have been. This is the percentage of stocks that have actually outperformed the S&P since 1990. And then the red bars, you can see in 24, it was less than 27, 28%. In 23, same kind of number. You have to draw all the way back to somewhere around 98, 99, where you had such a significant concentration or narrow rally of stocks that outperformed. And again, it just brings the difficulty of investment into the whole idea here of how and where to put your money. So warning bells and risks. Concentration risk is definitely one of them. The key other risk here, and I've touched on it, is valuation risk. If we compare, the growth index to the value index, particularly since 2020, we see a massive dislocation in valuations between value and growth and just the general MSCI. So the blue line is growth, the black line is value. And we saw during COVID, this extended out in terms of growth to about 33 times and then came back into 22 during 2022, which, was reasonable. And it's now pushed back out to about 30 times, which is making the growth index look very expensive relative, certainly to value that hasn't necessarily had the same effect. Breaking that down a little bit differently, and this is on the S&P index, you see how it's really only been the large cap information technology sector And it's all been in PE re-rating. It hasn't necessarily been in earnings. And that's the worrying bit. The setup in 2021 was very similar. You had a re-rating of all of these stocks. You had interest rates very suddenly rising and then a capitulation. And when you have this multiple compression, there is no downside protection. And that's the worry here. One may argue, these stocks are different. They're great quality businesses, strong balance sheets, free cash flow, blah, 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 blah. But the reality is, as we saw on Monday, when the market doesn't like NVIDIA and the stock can drop 17%, it doesn't take much. So what are key risks going into 2025? And we could probably discuss this for the next hour, but I've got about 4 minutes. AI indigestion. NVIDIA has really been the poster child of the whole AI move. And the weekend was food for thought. All this CapEx that's been spent. And tonight's a big night. We have three of the big companies reporting, Microsoft, Meta, and the like. And everyone's going to be watching what they have to say about CapEx and how they're going to utilize this CapEx. And the worry is that, guys like the AI guys have spent hundreds of billions on their model, whereas if it's true, DeepSeek can basically spend 5 million, call it 30 million, on a model that gets you the same productivity and loses, and uses a fraction of the energy. So this could be, a Sputnik moment, as some have called it. You could see a race to the bottom. And if you are someone who is selling shovels and all of a sudden your shovels don't need to be as expensive as the guy next door, this is a bit worrying. And so you could see a deep change here in the mindset of investors. And as I say, all these hyperscalers that have this or have had this shield of armor and have this multiple kind of defense mechanism maybe aren't as defended as they have been in the past. So it's a tricky moment. It's something to watch, but it could be, quite big going forward. Other risks are Trump 2.0. We've had him before. We kind of know what to expect, so it's expect the unexpected, but things we got to watch out for. We know about deregulation. That should be good. Lena Khan is gone. It should be very productive for the US domestic market. Tax reform, very productive and positive for the US market. Tariffs, a big question mark here. It could be very, very difficult for Europe. It could be for China. It's too early to say, but tariffs are inflationary and they're not necessarily a good thing. Immigration's the same kind of thing. Inflationary, not necessarily a good thing. Environmental, drill baby drill, that this should be good for the US domestic drillers. And then Doge, well, we don't know what to make of that quite yet. But the impact of all this, you've got to think, is going to be inflationary. And this is the next risk. We've seen how the US T-bill really plays with the market. The Fed did pivot, and we've seen the T-bill come off. But all of a sudden, the market has the expectation that interest rates are coming down over the next few months and the year. And if inflation starts creeping back into the market, you have worries that there could be a head fake. And we saw this at the end of December. We didn't have the Santa rally. We had actually stress in the market because inflation was creeping back. So something to look forward to. Geopolitical risk, it's always a risk. With China, it's now become a bigger risk because DeepSeek is an open architecture. We're not quite sure what the US are going to make of it. We're not sure what the US is doing with China in terms of tariffs. China as an economy hasn't really shot the lights out just yet. They're struggling. And I think the biggest fear and worry here is the invasion of China of Taiwan. And in this graphic, all I'm trying to show you is how much the world relies on Taiwan as the biggest semiconductor producer. It produces over 60% of all semiconductors in the world and about 90% of the more sophisticated semiconductors. So it is a very strategic territory and one that we need to keep our eyes open on. The Middle East, US, Israel, not quite sure that the US and Israel are quite finished with Iran, and this could lead to, further trouble down the road. And the Russia-Ukraine story, I think, is well documented. So just wrapping up very quickly, this is the Global Equity Fund. This is the profile of our fund, which is in light blue. And this is not a performance chart. This is just showing you our correlation. We yin and yang with value. Value is the dark blue, growth is the gray. And you can see that as the dark blue lines go down, the light blue, which is the Credo Global Equity Fund, go down. So if you're looking to strategically put yourself in a fund that has more correlation to value than growth, then I think we are well placed. One reason why we have been able to outperform the value index is because we have a great qualitative overlay. So we have something that's more akin to performance in line with the MSCI, but with a value bias. And just again, to bring that point home, if you look at the average PE of the global equity fund, it's about 14.9 times, which is very much in line with the MSCI value index compared to the MSCI world and growth, but yet we're getting better returns than in the value index. And then my wagon wheel quickly, just to show you how we are set up going into 2025. This has changed slightly since Monday. Alphabet was our biggest holding. We've trimmed that down by a couple of points on Monday. In terms of the Mag 7, we do still own Microsoft, we do own Meta, and we do own Alphabet. We don't own the other names. We are underweight IT, as you can imagine. We have been overweight financials for a long period of time. Within those financials, it's a lot of insurers and it's quite diversified. We're quite long healthcare, which has not been a good trade coming to 2025, but as of Monday, looked very, very interesting. Other interesting tidbits there is geographically, it looks like we are overweight the UK. It's not the case. We own UK domiciled countries, which we argue are trading on significant discounts to their global peer group, yet they are global leaders. So we're quite optimistic going into 2025. We think there's a lot of food for thought. If you're a growth investor, I'm not chasing you out of the market. I'm just saying be careful. There are a lot of warning signs out there. Dislocation may come. We don't know how it's going to come. We saw on Monday a taste of it. And if you have a follow through, you just got to be very careful. We like the kind of stocks we own. We are an all green, all weather type of fund. We may not perform as well during periods where you've had such significant movements in growth, but we will give you good returns, and we are a hedge when things do turn bad in the markets. And that's it, Eugene.
Jared, very insightful indeed. And I mean, it's an old saying, the longer the party, the bigger the hangover. I don't know when that hangover is going to come, but let's see. And you're 100% right. There is a big dislocation. If I listen to the likes of the BCA, who was more bearish going into 2025 and towards the second half of 2025, one of their key concerns is a further unwind of the carry trade. Cheap money coming out of Japan, going back into the S&P 500. We've seen a bit of that unwind in 2024. Is that one of the factors or the macro factors you are watching if Japan were to change their policy on rates and going into real rates?
Yeah, I mean, definitely. Some actually argue that the sell-off on Monday was not necessarily all related to DeepSeek. There was actually a shift in Japan where they raised rates again. So it was hidden. It is a factor. We saw it in August of last year as well. It's, again, I think it's quite well documented. It's a good point. I didn't put it in the presentation. But I would think the bigger worry is the Mag 7 and the concentration risk of valuations of these companies, and the fact that they are so highly weighted in these indices. And if you get, rollover like that, and then you get margin calls, et cetera, we just get this kind of cannonball effect that pulls the market further and further down.
Does speak to a time for better diversification in portfolios, most definitely. Your fund served clients well for a very, very long time. Jared, thank you so much for coming in this morning. It was really great to have you on, and the Credo Global Equity Fund available on most platforms. Jared, thank you so much. We'll chat to you again in the very near future. Thank you. Right, moving ahead towards the end of 2024, we all got very excited when we saw some very good returns from global property. A lot reckon that global property is tied to the hip with the rate cutting cycle, and there should be great benefits for that. But towards the end of the years, with US bond yields trading higher in December, things changed significantly. Or did it? Where to go from here on global property? And in here to share their insights are the true experts on global property. Joining us now is Anil Ramji from Sesfikila Capital. Anil, thank you so much for coming on this morning. Looking forward to your views on property.
Thanks, Eugene, and good morning, everyone. As Eugene said, my name is Anil Ramji, and I'm from Sesfikila Capital, and I'll be chatting to you about global property. So just a quick update on Sesfikila Capital. We are a specialist listed property asset manager offering 3 strategies, a local, a global, and a flexible fund that all have delivered top quartile performance. We currently manage approximately 17 billion in assets. The business remains owner managed, and the investment team has an average of around 16 years of experience. Okay, so just as a reminder, the local property index, or the OP, has about 50% see-through offshore exposure. But most of that is in the UK and Central and Eastern Europe. The global fund gives you access to global developed market real estate. So majority of the REITs are located in the US, around 72%, followed by Europe and Japan. But you also have access to the UK, Canada, Singapore, Hong Kong, and Australia. More importantly, the global space offers you a very high degree of choice and specialization. So just to give you some history, about 24 years ago, the global REIT market was very similar to the South African market currently, where about, say, 90% of the total market cap was concentrated in the core sectors of office, retail, and industrial. You fast forward to today, non-core sectors like apartments, single-family resi, data centers, to name a few, now account for 60% of the total market cap and 95% by the number of stocks in the index. So you have, more than 16 different sectors to choose from, and the ability to invest in a certain sector in a certain location. So I'll give you an example of that. If you wanted exposure to apartments in Berlin, or offices in Manhattan, or data centers in Singapore, you can find a REIT that focuses specifically on that property type in that location, which gives you that high degree of choice and specialization. So our fund, our global strategy, has about 1.2 billion under management and uses what we call the concentrated thematic approach to portfolio construction. So concentrated in that the fund holds up to 60 stocks compared to the benchmark that has more than 350 opportunities. And thematic, in that we research, we debate, we identify key themes that are happening globally, and we check those themes against real estate fundamentals. Things like supply and demand, vacancy rates, rental growth, with the ultimate objective to be overweight stocks or sectors that we believe will be beneficiaries of those themes, and then to be underweight stocks or sectors that we think will be disrupted by those themes over the medium to the long term. So just quickly looking at how our portfolio is positioned currently. On the left is our regional weights relative to our benchmark, which we limit to a maximum 2% overweight or underweight. And we do this as a risk mitigation tool. We don't think we're good at forecasting FX rates or even political stability for that matter. We believe we have a competitive advantage in choosing stocks and sectors, and that's where we show our conviction. So as shown on the graph on the right there, where there isn't any weight restrictions, as you can see, we very overweight data centers, single-family rentals, student accommodation, and shopping centers. And on the left-hand side of that graph on the right, you can see we continue to be cautious on the office sector. So basically, this is a summary slide of a few themes that we're looking at the moment. And, starting off with AI and big data. So remember, the first phase of demand for data centers was driven by that massive amount of data being created. Think about Netflix, Disney Plus, all those TikTok and Instagram videos that need to be stored somewhere. Now you combine this with the adoption of cloud computing, which led to very, very strong demand. Now you got this new trend of AI, which brings even greater potential, especially because AI requires significantly more computing power. And remember, data center leases are based on power usage and not square meters. But I actually have a slide on this a little bit later. Examples of necessity-based real estate, this can include healthcare, which is driven mainly by an aging population, especially in the US, Europe, and Japan. In the US, the baby boomer demographic is the second largest demographic, but it's also the fastest growing demographic. So basically people age 85 and older, they have the highest per capita use for healthcare services, and this has resulted in very strong demand for healthcare real estate. The third box there is what we call demographic dividends. Again, also linked to shifts in the age structure of developed economies, particularly the millennial generation, which is now the largest demographic group with approximately 230 million people between the US and Europe. And millennials are often referred to as the renter generation, right? Mainly because they can't really afford houses because of house prices, and secondly because of high interest rates. So the strong rental demand coupled with very limited supply has driven vacancy rates in the single family apartment space down to between 2 and 4%, and rents are expected to increase anywhere between 3 and 5%. And then lastly, the resurgence of retail. This has been fueled by a very surprisingly resilient consumer, and also a shift back to in-person shopping. I mean, post the pandemic, people wanted to go to malls again. E-commerce is still growing, but what retailers have decided or realized is that they have to embrace the omni-channel strategy and realize that brick and mortar stores actually remain very essential to profitability for their businesses. So the strong demand coupled with historically low levels of supply has pushed vacancy rates to close to historic lows of around 4%, and rents are expected to grow 3 to 5% there as well. So just looking at two themes in a little bit more depth, starting off with the necessity-based real estate, specifically senior housing in the US. So as I mentioned, in the US, the age group of 85 years and older is expected to grow at a 4.5% CAGR through to 2030. This is compared to flat growth during the 10 years prior to 2020. So if you see the chart in the middle shows supply, which is now 80% lower than its peaks in 2018, and now only represents about 1% of existing stock. So occupancy rates have recovered to around pre-pandemic levels of around 85%, but we expect occupancy to actually continue trending upwards towards 95%, driven by this very strong fundamental picture. So in this sector, our top pick is a company called Welltower, an $85 billion REIT, which is projected to have same-store net operating income growth for their senior housing exposure of nearly 20% for 2025, and then just on average around 12% earnings growth overall. And then moving to data centers. So demand for data centers is driven by the adoption of cloud computing, and now this AI investments by all these hyperscales, so Microsoft, AWS, Meta, Oracle, and that demand is expected to grow 12% annually till 2030. That's a base case scenario. The best case scenario is around 15% CAGR over the next 5 years. So from the center graph, we actually show AI applications require significantly more power. So for example, a simple Google search uses about 0.3 watts of power per search, whereas a chat GPT prompt consumes about roughly 10 times that amount, so about 3 watts per chat GPT prompt. Image generation using AI requires 50 times that amount of power, and video AI requires an unbelievable 10,000 times more power. And again, remember, data center leases are based on power usage and not square meters. On this demand, I just wanted to point out that we also are looking very closely to what all the hyperscalers are going to talk about CapEx. If you think about the next few weeks when they report results, something that I wanted to point out is that only last week, Friday, Meta actually came out and said that they're increasing their CapEx spend 60% in 2025 to around $65 billion. So we are gonna, DeepSeek is, could change things, but for now, we just keep an eye on the CapEx spend, keep an eye on these hyperscaler results and how they're changing, or if they do change any of their CapEx spending. In terms of supply, there are constraints to supply. So things like limited power availability, limited land, and regulation. So there's something called GDPR in Europe, which is basically a regulation that says data created in Europe needs to be stored on European shores. And that's all driving vacancy rates down to about 2% in US and Europe, and just 1% in Singapore. So we expect revenue growth of around 9% annually over the next 3 years, with rental reversions reaching as high as 40% in some of the core markets. In the data center sector, our top pick is a company called Keppel DC REIT, which has about 67% of its portfolio in Singapore data centers, with the remainder of the assets in Japan and Europe. This trades at about a 22 times FFO multiple and has about 12% CAGR. And we expect around 40% upside on some of their short-term rates. Just moving to valuations and outlook. So, we've discussed trends and themes that we invest in, but it's, an important step in the process is actually assessing those themes against actual real estate fundamentals. So the graph on the left there is the occupancy rates, and we use this as a sort of proxy for demand. And as you can see, retail is currently at an all-time high. Apartments are relatively stable. Industrial occupancies have actually declined slightly from its peaks in 2022. However, offices continue to lag since the pandemic, dropping to around 86% occupancy rates. That being said, if you look at the graph, there has been a small uptick in Q3 2024, which could indicate that office occupancy rates, particularly in the US, have actually bottomed out. So overall, the REIT sector is operating at a 94% occupancy level. And what gives us further comfort that these occupancy rates will remain relatively strong and keep the bargaining power in the hands of the landlords is the supply picture, which we show on the right there. So using retail as an example, between the 1980s and 2008, there was around 2 to 2.6 of stock or new square meters added annually. That dropped down to around 0.6% between 2009 and 2019. Today, that number of new stock is basically 20 basis points. So all-time lows. So in general, because of higher financing costs, higher material costs, higher labor costs, basically higher construction costs, construction starts across all sectors have declined anywhere between 40 and 70% from recent peaks. So the improved supply outlook suggests that REITs are fairly well positioned to continue growing rentals by more than inflation going forward. Just moving on to balance sheets. So here we just focus on the US market, which accounts for around 72% of the overall market. And you can see loan to value ratios have declined from just over 40% 2 decades ago to the current level of 31%. You can see it dropped to 26% just before the rate hiking cycle started. And since then, as interest rates went up, cap rates expanded, and property values have obviously adjusted downwards, ranging anywhere between a 6% decline for malls to a 36% drop for offices from their 2022 peaks. However, if you look at 2024 in isolation, it is the first year we saw property values go up again by circa 5% or 4.8% to be exact. And we expect this to continue this year with values up again in the low single digits. So overall, global REITs have an LTV ratio of about 35%, with about 70% of the debt costs fixed for an average of 6 years, which shows that balance sheets remain relatively strong. In terms of valuations, the sector is attractively priced both relative to its historical averages and the underlying assets. So we think about this by looking at the price to funds from operations or the PE ratio for the sector. And as you can see, we entered 2025 at around a 14.4 times multiple. And this is compared to a historical average of around 15.7 times. More importantly, earnings growth is expected to accelerate. So we expect, we basically in quarter 4 result season, and we think we're going to end the year with around 4% growth for 2024. This should rise to around 5.5% for 2025, and then closer to 6% for 2026. So you've got that multiple, that multiple gap relative to history, and you got accelerating earnings growth. The graph on the right shows price to NAV for all the different sectors, and at the start of the year, the REIT market was trading at a 9.3% discount to NAV. However, you can see within this, the healthcare and data centers traded at a premium to NAV, while offices and hotels actually traded at a discount, so 23 and 25% respectively. And then lastly, trying to basically put everything together. If you think about the forward dividend yield on global REITs now, it's around 4.3%. We've modeled approximately 6% dividend growth, and we think that's a fairly conservative estimate given that payout ratios are actually below their long-term averages. We assumed a US 10-year bond yield 12 months ahead of 4.2%. That's a pure Bloomberg consensus number. We don't try to model that. But one thing to note is that exit bond yields can influence the overall return expectations quite a bit. However, we've modeled a slight derating of around 60 basis points relative to bonds. And as shown here over 1, 3, and 5 years, we can expect anywhere between 9 and 10% in USD from the asset class, which is very much in line with what the sector has delivered over the long term, which is in between the return from equities and the return from bonds. Thank you very much.
Anil, thank you very much for those insights. Maybe a quick question from my side. We've seen investors nibbling on global property over the past 12 months as a good diversifier in portfolios. We all know that some asset classes are price expensive. Global property is still relatively cheap to a lot of those asset classes. But US bond yields rising end of December. We've seen a big wobble in global property. But more specifically, I mean, how sensitive are your holdings to yields? You indicated a lower bond yields towards end of 2025. But the sensitivity, or what I'm actually after is how volatile can global property, more specifically your fund, be if we were to see another increase in US bond yields?
Yeah. So I think we'll just take a little bit of a step back and think about the first slide I spoke about and the availability of the specialization in the sector. Remember, because you have the option to invest from anything from hotels right up to triple net lease REITs, they all they all perform differently in different interest rate environments. So I'll give you an example. The hotel sector actually performs very well in an increasing rate environment. So if you think about increasing rates, you think about expenses increasing, but hotels have the lowest weighted average lease expiry profile, basically 24 hours, right? So, you can shift the portfolio. If we expect interest rates to actually go up, you can shift the portfolio towards hotels or towards lower weighted average lease expiry profile sectors. So things like self-storage, which is a monthly lease contract. And then the opposite end of that, you got things like triple net lease, which has a weighted average lease expiry profile of anywhere between 10 and 15 years. And obviously, as if interest rates spike and keep on going up, the spread investing in that sector is actually detrimental to earnings growth. And therefore, that sector tends to underperform, historically underperformed in an increasing rate environment. So we've actually used a sort of barbell investment method where we are actually overweight hotels at this point in time, but we are sort of neutral to slightly underweight on the hotels, on the triple net side. So we've taken a barbell approach where we have taken account of the increasing rate cycle or a decrease or flat rate cycle.
Makes a lot of sense. And I mean, again, if you are looking for good diversifier in portfolios, property is still trading at good valuations, despite some of the recoveries in 2024. And what you've showed there, your last slide, and definitely interesting potential outcomes over the next 12 months. Anil, again, thank you so much for joining us this morning. And like I said with the introduction, you guys are truly the experts in property. You illustrate that to a great extent, and we'll keep looking out for updates on Cess for Kilo. Thank you so much.
Thanks, Eugene.
Right, next up, we are moving a little bit more to global multi-asset. And for our next session, it's my privilege to welcome Head of Global Investment Strategy at Portfolio Metrics, Brendan de Jong, here to share insights on offshore investing. Good morning, Brendan. How are you doing?
Morning, Eugene. Very good, thank you. And thank you for the opportunity.
Fantastic. Maybe just before you start, and for the audience who don't know Portfolio Metrics, I mean, we've seen Philip Bradford on the fixed income side many times. But at Portfolio Metrics, you manage a huge range of local and global solutions covering all asset classes. So you're in a very good position to comment on various asset classes. And if I may, I think Portfolio Metrics is one of very few investment managers whose solutions actually plots on an efficient frontier. So there's something you're doing very well when it comes to your asset allocation modeling and how you look at portfolios. And I'm keen to see some of the insights you're going to share with us this morning. Thank you so much.
Thanks, Eugene. That's a fantastic intro there. You've taken a big responsibility off my shoulders. So thank you for that. And yes, just talking a little bit about Portfolio Metrics, as we have been around for 15 years and we've grown to a manager with 94 billion rand of assets under management. And importantly is we have a global presence with offices in Dublin, Ireland, Johannesburg, Cape Town, as well as London and United Kingdom. And I think very much the success of our business has been built on the back of the success of our partners. And I feel confident in saying that because ultimately the reason why we exist is we try and make our partners' lives as easy as possible. So we try to free them up from distractions so they can focus on things that matter to them, which is growing their own businesses. And really the way in which we do that is we offer a very strong investment capability with a demonstrable track record, as Eugene said, through single asset classes as well as multi-asset classes. But very importantly, this is leveraged through technology and then also very strong partnership that we have with our clients. I think from our perspective as an investment manager, our core purpose is to maximize investor value, and with that is understanding what is actually valuable to our investors. And first of all, from our perspective, is performance really matters. So our clients don't want to fall short of their goals, which is really important. But in order to generate returns, you ultimately need to bear risk, and so risk really matters as well. And so we're trying to build portfolios where we don't want to take too much risk in order to generate those returns, because if you take too much risk to generate those returns, ultimately what you do there is you introduce composure issues. And so the journey really matters for our underlying investors as well. And certainly the way in which we put portfolios together is taking heed of these three core principles. From our perspective, we see investment management actually quite simply. It's really a cost-benefit kind of trade-off. And we've built our investment process around this. And ultimately, the kinds of trade-offs that we are doing through essentially an optimization process is on multiple levels. But as a multi-asset investor, asset allocation and strategic asset allocation is we are really blending portfolios to try and maximize expected excess returns relative to risk. So cost benefit is risk return on an absolute basis. Then how we choose to implement that asset allocation is very important. And there we are optimizing or doing a cost benefit exercise on active risks and active returns. And then very importantly, as an asset manager, where I think we might be unique to some of the other panelists over here, is we choose to incur costs, and we are free to choose different strategies that we think will offer us superior expected returns relative to risk. And ultimately, that frees us up to select strategies across from very, very cheap passive all the way to expensive discretionary active management. Now, this is our track record of our offshore range over the last 10 years in US dollars, the orange line being Morningstar category averages, green blobs being some well-known balanced funds, and then our blue line there is our risk profiled range that Eugene referred to. And ultimately, these are risk profiled and controlled portfolios on a multi-asset basis that are globally diversified, that makes use of specialist managers. And so we'd be looking at a lot of the panelists over here in our own accord as to and trying to decipher as to whether they are fit to be introduced into our portfolios. All right, so moving to markets, and I think this is also really important to say straight up, is we don't necessarily build portfolios by coming up with some sort of a view and then positioning portfolios in that respect. It's very good to know where you are in the market, but also to understand the fact that markets are very risky. It's very difficult to look to the future, and we think that you'd be making a mistake if you generate a view and then build concentrated positions into that. We prefer to look at it from a risk basis and diversify appropriately at those various levels in order to make our portfolios stable no matter what is thrown our way, because as we've seen time and time again, many things happen in the markets that are basically unpredictable. But ultimately, what we do know is that the US has dominated markets essentially since global financial crisis. And over the last 6 years, they've generated 5 years calendar year returns of above 20%. And so the US has dominated. The US dollar has been very strong, but that has been for good reason. You've had strong earnings growth, a strong economy coming out of the US, superior profit margins, et cetera, et cetera, et cetera. And so the market has rewarded those companies within the United States that have ultimately moved the economy. But we now sit at a different stage to where we were in 2010, and I think this was alluded to by the first speakers in terms of the concentration. And what you can see here is US markets now making up almost 75% or 3/4 of the developed world, and then 2/3 of the entire global equity market space. And so that really becomes something that you need to be aware of when you are positioning on a global basis, and really start thinking about it on an asset allocation basis as to what that might mean from a positioning perspective. And I think really the crux of the matter is that that dominance of the US has been driven, as we know, by a very, very small handful of companies. And this is a really interesting chart because it likens a single company to entire countries. And so basically what this is saying is that the market capitalization of Apple is essentially the entire market capitalization of the Japanese equity market, and so on and so forth. And I did a little bit of back of the matchbox calculations, and the two-way sort of movement that we've had in NVIDIA of -17 and then +8 or 9 or whatever it is, essentially has resulted in, over the last 2 days, the NVIDIA market cap loss has been equivalent to the entire South African annual GDP for 2023, according to the World Bank. So that puts it into perspective. These are massive companies that are making more than 20% of the market capitalization of the entire equity index. And what that means is if you choose to default to passive, there's no such thing as defaulting to passive, is what that means is you actually are making company calls on that because of the relative size of these dominant companies. But also just looking at it on a regional basis, and this was also alluded to, but on various matrices, so the CAPE index, forward PE, trailing PE, price to book measure, dividend yield, Ultimately, the US is screening really, really expensive, and on the scale over here is more than 25%. And then everywhere else is kind of not necessarily screening cheap, but certainly cheaper relative to the US. So again, it's just highlighting the fact that we need to take cognizance of the past, what that means in terms of what the market structure is right now, and then also on a forward-looking basis, what that means from a valuation side of things. And I think we've spoken about this ad nauseum as well, is US large caps relative to their own history, really high over here. But not all of US is expensive. So if you start moving below that sort of really, really top end of the large cap spectrum, you start having opportunities there. And that's also where you have more active opportunities, really theoretically, that can be taken advantage of from active managers. But US small caps kind of sitting at value, and basically also the rest of the world. So this is something that is very, very important. It's the concentration and it's the valuation risk that's coming hand in hand in markets at the moment that people need to be cognizant of. Now, moving very quickly to the other super asset class away from equities is global bonds, and there has been some very unusual behavior in global bonds since the Fed started cutting rates in September. Now, this is a very interesting chart, and what you've got in green is the current cycle, and in gray is the average of past cycles. And you can see in the build-up to the first Fed cut, essentially the market behaved the way in which it has in the past. And so if you were leading to being a more evidence-based type of investor, you'd be saying, okay, well, this makes sense, and so I can position my portfolios, et cetera, et cetera, et cetera. But if you did do that, you then would have taken a bit of a hiding, because according to past, the 10-year yield after a Fed cut actually carries on to sort of stay at those current levels, or actually decreases. But the exact opposite happened, and it happened very, very quickly. And then what made matters even worse is that equities continue to outperform in that situation as well. So positioning your portfolios according to what happened to the past is not necessarily a very good way of protecting your portfolios for the future, but it also highlights the very, very unique situations that we're sitting at in the market at the moment from an inflationary perspective, fiscal policy risks, et cetera, et cetera, et cetera. But what we have seen is government bonds have normalized. Things look very, very different to what they did just a few years ago. And you can see that over here through various regions. But again, the point is here normalized. They are not cheap. They've just come back to normal levels in terms of what we were used to, probably pre-GFC. But they are offering nominal returns to us, and also, very importantly, real returns to us as well from a bond perspective. And this is not everywhere. There's a deflationary issue coming through from China. And this is looking at the 30-year yield of Japan versus China, and for the first time has actually breached over here, which is something to look out for, and is a global factor that will enforce that should affect global asset allocation thinking. But ultimately, there is almost a gravitational force when it comes to fixed income. We've spoken about this quite a lot, particularly when we're talking about a product like dynamic income that Phil's very involved with. But really, your starting yield is a very good indicator of what you can expect from bonds on a forward-looking basis. And at the moment, this is where we are over here. This is showing where returns have come from an income return and a capital return basis in the past over various periods. And you can see here 2020 to 2024, slightly different, where there's obviously we had those inflationary scares, and so capital loss over here. But really, what you're looking at from a fixed income basis is your starting yield is a very good indication of what you can expect on a forward-looking basis. And so the range of returns over here for a starting yield of where bonds are at the moment is anywhere between 3 and 8 or 9%, which is quite healthy, actually, for a US dollar multi-asset type of portfolio. But there are risks that we need to be cognizant of as well. And if we were to look at things on an equity relative to a bond perspective, so look at an excess cape yield, which is basically the inversion of the cyclically adjusted PE. And so the lower that is from an equity perspective, the more expensive equities are. But you can see here for high yield, still priced more attractive relative to equities from a fixed income perspective over here. But you can see that those yields have gotten tighter. So on an corporate bond investment grade yield basis, you can see here healthy yields available to investors on a global basis. US, Europe, pounds. You're looking at returns anywhere between 3-4% up to 6% on a nominal basis. Same thing in high yield, up from 5% all the way to 8%. Again, relatively attractive versus equities on a nominal basis, but you need to be aware that on a spreads basis, they are quite tight. And so you can be sucked into the very, very understandable sort of movement of wanting to take advantage of those yields available to you, but understand that pretty much across the board, spreads are tight when it comes to fixed income relative to their own history. So that's also a tale of caution of there is fixed income offering sort of attractive yields to you, but you need to be very, very selective of where you are. So that brings me to my summary slide, and I've gone through this very, very quickly over here. But on an equities basis, US has ultimately continued to dominate equity markets, and there's nothing to say that cannot continue to happen. And this is a very, very important point when it comes to asset allocation and thinking about positioning, etc., 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 and also how aggressive you choose to be in how you put your positions together, and ultimately the calibration of your conviction, because you can make mistakes. People have been talking about how expensive US has been for a very long time, and if you've positioned aggressively against that, it's really, really hurt you for a long time. But taking cognizance of where we are at the market, concentration levels and valuation, it's definitely something to bear in mind. And that's this point of the market has certainly continued to get narrow. And what has happened over the last couple of days in terms of how aggressively a stock like Nvidia and many other stocks as well outside of that has kind of tied to this, so even utility type of companies, etc., 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 it's really, really strong movements in those shares. And if that's a big part of your portfolio, things can move very, very quickly for you, and that is not very, very good when it comes to thinking about how the journey is experienced for your investor, which, as we say, is something that really matters to us. The rest of the world is close to fair value. It doesn't necessarily, and yes, obviously there's a lot of nuance into this. I'm talking about at an index level. They remain close to fair value. The US certainly is not at that, and particularly if you're looking at the largest of the large cap. But that does definitely offer some opportunity, as what has been mentioned in the past, just in this presentation by Eugene, I think, is that there are opportunities outside of the very obvious that are available to us. And so diversification certainly has scope to pay off within a well-structured multi-asset portfolio. From a fixed income perspective, government bonds offer a positive outlook on a nominal basis, but you definitely need to be selective, particularly when it comes to credit and high yield, and looking at high quality and good issuer selection. And just to give you a little bit of a flavor of how we would go about that, that is something that we would look to outsource to specialist managers to actually manage that on our behalf. So that was a whirlwind whistle-stop tour there. And then, Eugene, if you have any questions, I'm very happy to try and answer them.
Brendan, a lot of ground covered indeed, and maybe just to test your views more specifically, I mean, everybody warns of high valuations on the US, but more specifically in your portfolios, be that Global Flexible or SA Balance Fund or Worldwide Flex Mandate. What do you do with the US equities at the moment? Are you starting to underweight US equities? Are you hanging on for longer? Because some will say, you know, don't bet against the Trump. And America is going to be great again, and there's still plenty of room for earnings. But where are you on US equities specifically? And if you start to underweight, where do you go?
Yeah, look, it's a fantastic question, and I think there's actually places to go even within the US market itself as well, and that's really hinting to some of the actions that we've been taking within our portfolios. I think it's really, really interesting from the way in which that we think about it on a top level regional basis. I think it's very difficult to do it like that because you're introducing a lot of randomness, really, because ultimately the large cap sector of the US is actually a global index in itself. So around 50% of the revenues of those big companies is coming from outside the US itself. And you need to take cognizance of that when you are positioning and looking at it from just a highlight level of regional is different. I think we look at it from an opportunities basis, and where there's the highest probability of us being able to extract value on an active basis on a higher probability situation. And certainly as you move down that market capitalization spectrum, you have less coverage, et cetera, from a sell side basis, et cetera. And so we are able to extract what we believe a superior excess returns relative to risk on that basis. And that's kind of how we view it. We are a little bit shy of making big regional calls explicitly in our portfolios on that basis, because you actually could have a lot of unintentional risks that you're bringing into the portfolio that you're not actually having control over. So we want a little bit more control, a little bit more specific risks that we are taking, and taking the risks that we actually want in the portfolios.
Very insightful indeed, Brendan. And like I said, a lot of ground covered in a very short space of time. To your audience, if you want to know more about portfolio metrics and how they manage assets, more than welcome to get hold of their team or the BCI team and get you in touch with Brendan. Brendan, thank you so much for coming on this morning. We really appreciate your time. Very insightful. And we'll chat to you again in the near future. Thank you.
Cheers.
Right, moving on to our next session. SA bonds, as we all know, added significant value to SA investors and portfolios the past year. But what about global bonds? Brendan did allude to some of the cautions on global bonds, more specifically in credit. But could this add to performance as a diversifier in global multi-asset portfolios? And here to share their views, it's my absolute pleasure to welcome Paul Fischer from New Road Capital, founder and CEO. Paul, thank you so much for joining us this morning. Looking forward
Great to be here.
Yeah.
Thank you. Looking forward to the year ahead, and welcome everyone and all the best for the new year. I hope you all had a great rest over the festive season, and 2025, I think we're quite positive and looking forward to what the year brings. So we're going to talk about something very different today. Some of you are not going to hear a lot of managers talking about, and specifically, talk about the bond space and what Brendan was talking about, specifically kind of narrowing out long-term US Treasuries. So when I talk about long-term US Treasuries, I'm talking about Treasuries 10 years plus in maturity, and really looking at those and seeing how those can diversify well with a portfolio. So before I get into my presentation, I always like to go through performance. Specifically, we're talking about our Global Flexible mandate today. It's the Global Flexible Fund, just coming on 5 years old now. It'll turn 5 in October of this year. But you can see it's had a very good track record of benchmark beating returns. It's a quartile 1 performer. We're quite proud of it, of what we've been able to do there, and a lot of new things and new initiatives that we've been able to put into the portfolio over the last few weeks. And that's what we're going to talk about today. Just on that, so we're a top quartile performer, but also that comes with bottom quartile fees. So, it's very important for us in dealing with our clients to make sure that we're giving them value. So you want to have good value, you want to have benchmark beating returns, but you don't want to be overpaying for that. So, if you look at our list platform fee on our asset swap at the moment, it's sitting at a total TRC that includes transaction costs and everything of about 125 basis points. So for a asset swap list platform fund, you know, that's quite low in terms of what you're getting out there in terms of global exposure in the rand space, but you're also getting good returns. So the reason we're able to keep those returns fairly low is because we focus mostly on asset allocation. So I'm a mathematician or an engineer by training. My team is as well. We're very quantitative based, and we focus mostly on asset allocation, modeling, and risk management. So we don't need an army of analysts looking at stocks and trying to pick what the winners are going to be in the future. We think that's harder and harder to do as the markets become more and more efficient. But what you can do is you can manage your risk effectively, and that's what we focus on. So getting into the actual crux of the presentation, long-term treasuries. So just a quick recap of where we are and where we find ourselves. If you look at the US, so the US, I mean, US equities since about the GFC really, you know, kind of cutting out COVID there, have been the only game in town globally, really. It's just been about US equities. They have been pumping. There's been a lot of innovation in that space, and you've done extremely well just being an S&P 500 investor over that time, probably beating any active manager in most regions worldwide over long periods of time. And if you look at bonds, and these are specifically long-term bonds, so 10-year plus US bonds, you can see how things have shifted after COVID. So you can see that COVID came in, everything got sold off, and what happened is you had a huge stimulus of money into that economy, actually globally, but specifically in the US, you had this huge fiscal stimulus, people getting paychecks, massive amounts of money being pushed into that economy, which obviously increased money supply, and that became very inflationary. And you've seen the sell-off in bonds. So up till that point, you actually had quite a strong rally in bonds. You had bonds actually doing better than equities, you know, from about 2000 all the way up to 2020. So over a 20-year period, you actually had long-term treasuries doing better than equities. And then because of all that monetary stimulus and that inflationary impulse that came through, you know, this pre-period is all fairly, it wasn't deflationary, but it wasn't inflationary. You had fairly stable inflation over that period. And you have this big sell-off in treasuries, and we think that provides a huge opportunity going forward. Just to talk about that, you know, the expectation of inflation around here after the GFC was also quite massive. You had quantitative easing, and you had all these sort of demand side Keynesian type economists all saying that it was going to be inflationary, and it wasn't. And the reason is that the money was pumped into the banking system and the banks didn't lend it out. So monetary growth in the economy actually didn't grow that much, and that's why you didn't actually see inflation. So, you know, that's what I want to talk about today. There's this kind of almost obsession with what Trump's going to do regarding inflation. We don't think his policies are going to be particularly inflationary, and I'll explain why shortly. But if you look, you know, the equity risk premium essentially virtually disappeared. So if you look here, this is the earnings yield of the S&P 500. You can see it's been coming down over time. This is since about 2005. It's just been coming down over time, sitting at roughly about a 4.6 at the moment. So that's the earnings yield on the S&P 500, very expensive. So your price to earnings obviously been coming down over time. Now, generally, your 10-year bonds should trade at a discount to that, because that's essentially the equity risk premium that you want to achieve or want to be compensated for by taking equity risk. And you can see that that's pretty much been there multi-decades, and it's pretty much since COVID, that equity risk premium has now disappeared. So investing in a 10-year bond, the yield that you would expect to get versus the earnings yield you'd get in the market at the moment is the same. Okay, now sure, you've still got growth expectations on the equity side that you could argue is still a built-in premium, but ultimately you can see the relative valuations of that have just disappeared. So relatively speaking, relative to the past couple of decades, you've got bonds trading at a lot higher relative valuations to their equity counterparts. Now the question is, you know, why are they so high at the moment? And the reason is inflation. So what could turn this whole thesis upside down, and what could, you know, pretty much render it meaningless is if inflation starts to uptick from here, or even kind of run away, and you know, that's a big question, is what are Trump's policies going to do with regards to inflation? That's really the crux. If you think that inflation's kind of just going to normalize and it's more structural in nature, then you kind of probably want to be in these long-term bonds, which is our view. So if you're looking at inflation, first, just a technical aspect. If you look at inflation, currently US inflation sitting at 2.9%. That's just US CPI, 2.9% on the last print. But if you look, there's a number in here. It's to just look at the kind of headline number can be a bit misleading, because there's a number in here called owner's equivalent rent. Now, what owner's equivalent rent does is it essentially will go to property owners in the US, phone them up, and they say, if you were going to lease out your property, or if you are leasing out your property, how much would you increase, if you could increase your lease agreement next year, by what percentage are you going to increase it by? So what's your hunch, you know? So if you're renting out for 10,000 Rand a month now, $10,000, let's say $1,000, how much are you going to increase it to next year? And they're going to aggregate all those answers and they're going to give an answer. Now, what happens is that's a lagging indicator in the inflation number, because if inflation is high coming into that, and you phone this, you know, property owner now, and inflation's been 5%, and you say, okay, well, how much are you going to increase your rentals by? He's going to tell you 5%, or maybe 6 or 7, you know. But then what happens is, as the inflation number starts coming off, they're still giving you these numbers of 5, 6, 7%. So that comes through at a lagging effect on the actual official inflation number. So if you look at it and you said, okay, so this owner's equivalent rent number at the moment sitting at about a 4.8% inflation rate. As I said, it's not a real number. It's not actually what leases are going up by. It's what people say they're going to put their leases up by. Now you can see that as inflation came through, the gray and the blue lines are actually real rental indexes. So these are like retail rental actual indexes that are showing you real rental growth values, aggregated numbers. So you can see, obviously, during you know, COVID, you had massive increases in rentals, and you can see how that lagging effect came through in the owner's equivalent rent. But since then, you've had this number drop off quite significantly, but you can still see owner's equivalent rent quite high. Now, if you just take an average of these, you know, not to be too technical on it, and you can go and say, okay, well, maybe, you know, real rental increases are sitting at 2%. So owner's equivalent rent should be sitting down there. It's currently sitting at 4.8. And you bring it back into this number and you cut 60% off this number, you're suddenly cutting 1% off this number. And suddenly inflation goes from 2.9 to 1.9. So just from a technical impact assessment with nothing else happening, you're going to see this lagging effect come through in the official inflationary numbers. And really the Fed's looking at these official numbers. They technically use a slightly different inflation metric than this, but still owner's equivalent rent will be part of that. So just from a technical point of view, but essentially just that normalizing can bring inflation down. Okay, the official inflation number will come down just on that. So, you know, if you look at the benchmark of 2% and you lop off 1% off here, you're actually below target. Now the question is, okay, so that's the kind of technical aspect coming through that we think is going to obviously bring the numbers down a little bit. In terms of what, you know, Trump's doing in terms of the fear around tariffs. So there's been a lot of obsession and talk around these tariffs and what's going on and what's happening with tariffs. Look, tariffs, if we look at Trump's first presidency, so obviously 2017 to 2021, you can see that shaded area is his first presidency. He started to introduce tariffs in about that first year of his first term, and he introduced these tariffs. You can see that inflation, the CPI, over that period didn't do a thing. Pretty much around the normal standard 2.2% growth target, wasn't inflationary at all. You can see what has caused it. So just assuming that tariffs are going to be inflationary on their own kind of is missing a lot of the picture. It's very demand side focused, and it doesn't focus on the supply side really at all. And that's something we want to talk about a little bit in this presentation. But you can see what really was inflationary is the COVID stimulus. So that COVID stimulus came in still in Trump's term. You can see obviously deflation in the beginning, the economy just shut off immediately, but you can see immediately that injection of money coming in. So this blue line is the M2 money supply. So that just broad money supply in the US economy. And you can see how that just spiked up. It's money supply growth. And you can see how it just spiked up. I mean, you're talking about at the peak, you know, north of 25% money supply growth coming into that economy. I mean, that's just a massive, massive fiscal injection. And you can see immediately after that inflation started to tick up. So if you know, on the supply side, more kind of neoclassical way of thinking around economics, money supply is really the big contributor to inflation. And you can see that really playing out here. And as money supply growth came off and actually went negative, you can see that inflation number coming down fairly quickly. So, you know, at the current number, 2.9, but as I said, for technical reasons, we think it drops below this. But really, the tariffs on their own are not inflationary. Why is that? Because it comes with other types of policies as well. So if you look at what Trump is trying to do, he is trying to, essentially what he's trying to do is he's trying to narrow this trade balance. So the US monthly trade balance at the moment, highly, highly negative, all right? It means they're exporting way more than they're importing. Roughly, it's about $80 billion a month that they export more than they import. So you annualize that, it's roughly $1 trillion a year that they have a trade shortfall on, that they have a balance shortfall on. So they are exporting $1 trillion more than what they're importing. Now, Trump wants to change that around, all right? He wants to bring more onshoring. He wants to bring more capability back to the US. So what he's doing is he's imposing tariffs. Now, remember, a lot of his tariffs are equalizers in the game. They're not really punitive. So there's a lot of tariffs on the other end, or favorable trade policies that have been implemented against the US for a long period of time that he's trying to undo in the form of tariffs. So it's essentially, you know, if you're a free market guy like we are, you say, well, tariffs theoretically are not good. What he's doing is he's trying to equalize. So he's trying to say, well, if you're going to impose punitive measures on us, we're going to do the same to you and try and equalize the game again. That's the important part of this. So it's not just a fact of punishing trading partners. It's really trying to equalize that game. And what you see with this, and that's what you've seen in the market, is you've seen this dollar strength. You've seen massive dollar strength, because if this trade balance can narrow by bringing on more onshoring and less reliance on exports, and that trade balance decreases, your dollar should be strong. Now, the dollar's been very strong in anticipation of this, okay? We still think it has the potential to get stronger if trade policies do get enacted fully. You can argue that some of it's rhetoric, but we still think Trump's going to be very, very focused on the US economy and getting that thing. You know, it's at the moment, it's already probably in the major global economies, the best performing economy. We think under Trump probably gets better from a relative scale. Europe, you know, China, those places are overregulated. They're not competitive. There's no innovation going on there. You really want to be in a place that is friendly to business. As being investors, that's where you want to be. So you're seeing the strong dollar. Now, what happens is, so just the first part of the tariffs, if you say, well, I'm going to increase import costs, so I'm going to increase costs on imported goods. But if the dollar strengthens, part of that increase has already gone away. It's already disappeared. Okay, so that's the first thing. So if you say, well, that's just going to be a tax on the consumer, not necessarily, because they're importing with a stronger currency. That's the first thing. The second thing is that the tariffs are most likely going to be accompanied by tax cuts. Currently, corporate tax cuts in the US, 21%. Trump cut to 21. He wants to go down to 15. So you've got another 6% in savings there. So a lot of that input cost will be absorbed there as well. You've also got energy savings coming through. Now, efficient energy costs are one of the biggest drivers of inflation globally. I mean, if you look at the inflation shocks, you know, the US Fed, and they're all obsessing about the hyperinflation of the 70s and 80s. Those are oil price shocks. Those are energy input costs that shock those markets. Oil prices went up 500%. Of course, you're going to get inflation. What Trump's doing, drill, baby, drill, you know, it's a mantra that he's had. Manger and drill, baby, drill, probably his two biggest mantras. And that's really going to bring down energy costs. It's going to open up supply. So that's what I'm saying. Don't just focus on the demand, focus on the supply side. It's going to open up supply. It's going to bring down energy costs, which is also a huge boon a huge relief. It's very deflationary force that if you bring down energy costs. So yes, you've got tariffs on the one side, but you've got a strong dollar, cheaper energy, and then just also corporate efficiency, deregulation. So he's cutting deregulation like crazy. I mean, he signed 300 executive orders already in terms of the US. He's already put moratoriums on certain spending. Just recently he sent out basically a notice to all federal employees about giving them an opportunity, giving them a payout to resign. So he's trying to cut down on the wage bill. I mean, there's a lot of tax, there's a lot of expenditure cuts that he's bringing into this thing too. So more efficiency, a smaller government, less regulation, those are all very deflationary forces. You've also got this overlaying sort of technological, let's call it revolution, that's also deflationary. So we think on a balance of probabilities, to just assume inflation's going up from, we think is short-sighted and kind of only looking at one half of the equation. We don't think it's going to be inflationary. And really what we think is going to happen is you're going to kind of go back to the status quo. So if you're looking at long run 10 plus year treasuries, so the blue line and the orange line, the 10-year and the 30-year yields, you can see that pre-COVID, so obviously, and that's the gray line's inflation, you can see pre-COVID, you had these things coming down roughly. It's a very deflationary environment, which we think you're still in globally. You know, you've got negative population growth in most of the world. There's a lot of structural deflationary forces out there. We don't think we're coming out of that regime at all. We don't think this is a special time in history. We think we'll go back to that. If you see where yields are back to where they were in kind of 2010. So, you know, you're looking at if inflation does kind of start ticking around, you know, it's volatile, but kind of start normalizing and back to the 2%, which is kind of our base case, you'll start to see those long run treasuries kind of normalize and come down a bit. And really they've over multi-decades, excluding this kind of unusual period of money printing, have come down by about 25 basis points a year on the long end. So if you look at our kind of base case, you know, we would say that, you know, if you just look on the short end now, so if you look on the short end, probably 1 or 2 cuts expected this year from the Fed, a lot less than what was expected previously. And that's why you've seen this kind of sell off in the bonds, and that's where the opportunity is coming from, that we believe. But you're getting about a 4.9% yield on those on that basket. So base case for us is if you have a 4.9% yield and you get a sort of 25 bip rally down in yields over time on a roll down, you know, on a base case, we're expecting in dollars to be doing about 8.6% a year on those long-term bonds, just in a base case. On a bear case, let's assume things are more inflationary than we think they are now. It's already priced in to a large extent. Let's assume those long-term yields do not move. Let's assume even if the Fed cuts on the short end, that the curve just steepens a little bit and those long-term yields don't move, you're still going to get the yields. So you're still going to get just short of 5%. But then the reverse is true too on the bull case. Let's say it normalizes a bit quicker and it's a little bit more deflationary than what the market's pricing. And maybe you get 3 cuts this year, or you get 2 cuts this year and a few more next year. You know, we could see, so what we priced here is just a 50 basis point move in that and the long end of the curve. You could go and get equity-like returns in dollars just from taking treasuries. And what I've also included in here is a crisis moment. And this is the reason we're specifically looking at long-run US Treasuries, is that they provide a great diversification benefit. If you take nothing else out of this presentation, take this out, in times of crisis. So if there is a sell-off in the markets and equities go crazy, no one cares about value. No one cares about which part of the globe you're in. No one cares about what you're invested in. Equity markets are going to get crunched in any kind of crisis, whatever it is. Let's say China invades Taiwan or whatever the case may be. Bonds in those times rally. So what we've done here, and they rally hard. And we know that there is a Fed put going on. The Fed is very, very concerned with protecting the economy and cutting rates if they need to. They've done it during the GFC. They've done it again during COVID. We don't foresee any reason they wouldn't do it again. So what we priced here was if you had a quick 200 basis point cut over a period of a 12-month period, you'd actually do about 38%. Because what would happen in a crisis, you'd cut rates and you'd do about 38% in dollars on those. So that would be a great hedge to equities coming off. And that's what we're kind of showing you here. So you can see during the GFC, you can see what happened. Equities sold off, bonds rallied. You can see during COVID, equities sold off, bonds rallied. So we're trying to look, so we're looking at the kind of the same example. So what we're saying is more than likely what would happen in an unforeseeable crisis is that equities come off, bonds rally because the yields come down. So that's what we're trying to show you here. We also just think from a valuation point, you know, you're doing fairly well. 8.6, close to 9% in dollars. If nothing happens, there's a fairly good return you're going to get in dollars, considering that the long run since 2000 annualized return of the S&P 500 has only been 8%. So it's a good, and if you consider going forward, you know, let's say 10 to 15% is kind of the consensus. You can take that with a pinch of salt, but you're not far off that with the bonds, and you're diversifying yourself very nicely. So that's what we focus on, is trying to diversify that and bring those bonds into the portfolio. So if you look at our current makeup, just basically our asset allocation, as I said, we use a lot of we asset allocation, modeling. We focus very much on how do you put these things together and how do you manage the risk. And you can see currently we've got about 20% of our global flexible fund in US Treasuries at the moment. Of that, about 18% are on the long end. So we do have some short end. We do have some credit, a little bit of credit in there. But for the most part, the majority of our bond exposure at the moment is long-term US Treasuries 10-year plus, 18%. And they're just going to provide that beautiful hedge. So if you get, we don't predict markets. If you do get a continuation in the bull run, fantastic. We still like, I mean, we slightly different to maybe some of the panelists. We still think that the sort of tech AI revolution is only just beginning. We think this DeepSeek kind of story is actually probably good for the markets in many ways. Definitely for your kind of platform as a service type guys, or software as a service kind of guys. So your Metas, your Palantirs, your Salesforces, those guys are going to do well because the cost of training and running those models has just become a lot, potentially a lot cheaper. But we still think even on the semiconductor side, you know, the thing about revolutions is that you're always hungry for compute. You're always hungry for computational power. And, you know, if we're going to get to a point where we're building robots that are doing our housework for us, you know, we're way away from there. So there's still a lot of demand for chips. We know we've had a few big initiatives coming out globally. So we still like the chip space. We're still exposed to NASDAQ. So we don't try and take stock bets. You know, we're trying to really just focus on getting alpha with certain tilts. So our theory is if you're going to invest in equities, you want equities that are going to do well when equities are doing well, and you want to diversify through that. You know, you don't want to go and diversify with like defensive equities or something like that, because if you get like a crash or something, it doesn't matter. You know, a cheap stock's going to fall just as much as an expensive stock most of the time. History shows us that there's no, you know, what you want to really do is you want to diversify with different asset classes where there's negative correlations in those negative time periods. And that's why we own so many treasuries. So hopefully, you know, we still get the rally, we still get equities doing well, but we do have that protection within our portfolio. So that's kind of me. Thank you, Eugene. Thank you everyone for your time. And as I say, all the best for 2025.
Well, great insights. So you actually answered one of the questions from the audience in terms of your exposure. But just quickly, that 22% global bond exposure you've got in your man at the moment, was that very recent, or have you been holding that position, or where did that position come from or start from?
We've kind of had it for quite a while. We're probably about 3-4 months. I would say that we've been holding as of sorry, I'd say about 2 months. So we've been holding at that level. We've always owned some bonds, but it was sitting at a lot lower level. So about 2 months ago, we upweighted that into this kind of sell-off that we've seen. You know, we just think that treasuries are providing, you know, kind of almost 5%. They're just providing a great opportunity. I would say we got in at about probably mid-4s, 4.5 to 4.5. So they have come off since we bought them. You know, I mean, you're never going to get the timing right, but we think that we're actually looking at potentially adding a few more. So we think it's just you know, you're never going to get purely on the timing, but we've held it for about 2 months at that level. We have had bond exposure in different kind of facets before that, but that's kind of been where it is. And we just think, and I mean, the main play is just you know, we don't think we're going to have as much inflation as what we think, or as what the world's kind of obsessing about.
I think that answers the next question from Christian as well. So you look at the cycle, you look over 12 months, so short-term rate increase is not to phase about. You're looking at what you're going to get from bonds in 12 months. Very last question speaks to tax, and if you can maybe go back one slide where you showed the crisis and the bear and the bull case scenario. So the bear case is you get your yield roughly about 5%. That's all interest bearing, and that, yes, that would be taxable.
Yeah.
But the bull case you've got there, and part of a base case as well, you're looking at the yield, and the interest rate movements will most likely then be capital gain and not fully taxed as income. And I think that speaks to your question on the taxability of expected returns on global bonds.
And that's actually one of the reasons why we like the long-term bonds, is because you do have that potential for the capital. So, you know, you could do this with short-term bonds as well, but you're not getting that same kick, that same protection. So you could argue long-term bond, you know, economics 101, your short-term bonds are less risky than your long-term bonds. It depends on what you own and what you're trying to hedge against. So for us, you want to have potential for more capital movement. Now, obviously, the risk is you could get more capital movement off as well. If let's say we're wrong and inflation goes up 2% and you get a sell-off in the bonds, the last thing you're going to be worried about is your bonds. If we get a 2% inflation shock from equities are down 40%. So you know what I mean. So you're still getting a protection against your bonds, against your equities, even in a bad outcome. But we think definitely more tilted to, I mean, you've seen, I've already shown the sort of relative valuations. There's no equity risk premium in the market other than expected growth. You know, but I mean, the relative valuation is very in favor of the bond. So yeah, in a crisis type environment or in a bull environment, you know, the blue line would be the yield. That's the yield you're getting. But the dark blue line is really that capital movement that you get on top of that, yes.
Your asset allocation modeling, very interesting indeed, in the way that you manage costs as well. A lot of clients we know are sensitive to that. Paul, thank you so much for coming on this morning. Great to share your views, and especially on global bonds. Thank you.
Thank you, Eugene, and all the best, everyone. Take care.
Thank you. Right, moving on we're sticking to global equity, and we're going to touch on emerging markets as well. GQG Partners is a well-established US-based asset management company managing in excess of $150 billion. The figures could be slightly higher since our last check, but here to share their views all the way from Abu Dhabi is Kevin Austin. Kevin, thank you so much for joining us this morning. From a SA investor perspective, we've got two mandates that we represent for you here. The one is a global equity, and you also run a very specific emerging markets fund. I think you're mainly going to focus on the global equity, but I'm sure there's going to be a couple of questions on EM, especially if you look at valuations in the US. Thank you so much, Kevin.
That is correct. Thank you, Eugene. I thank you all the BCI folks for having me on today. I'm going to go ahead and share my screen, and we'll take a few minutes and just to introduce GQG. I think we're kind of one of the a boutique that runs $153 billion, as you can see, that really nobody's ever heard of. We were founded in 2016 by our founder Rajiv Jain and Tim Carver, our CEO, and so we've had some success growing in that time. Rajiv's track record goes back many years at his prior firm and a Swiss investment bank, and so here we are today, and you can see we run 4 strategies as you alluded to. Across regional diversification, we offer a UCITS version of the emerging markets and the global strategy, as well as the US, that is available on many platforms. And it's really just one team and one process and one philosophy that manages these strategies. They're all run identically in terms of the actually selection process that we use and our underlying investment philosophy. The really difference is just the geographic constraints that we put on the portfolios for the various investors. Our headquarters are in Fort Lauderdale in the US. We also have offices in New York and here in Abu Dhabi, and then sales and services offices throughout the US and in New York as well. We're a publicly listed company on the New York exchange. So looking a little bit deeper, I'm going to spend a few minutes just giving a little background, because I know many folks may not be as familiar. I think this is the first time that we presented on this. To my knowledge, is the first time we've presented on this platform. So I just want to spend a few minutes to talk about, who GQG is, our background, our philosophy, and a little bit about our history, and then we'll get into a little bit more of the details about the portfolio, how we're currently positioned, and how we're thinking about the world as we are global investors. But when the firm was founded by Rajiv and Tim, there was really 2 main objectives, 2 goals that they wanted to deliver. And one was to be the gold standard in client alignment. And what we mean by client alignment is really, we eat our own cooking. Both Rajiv and Tim have the bulk of their liquid net worth invested in this strategy. So we're invested alongside our clients. And that drives specific behaviors because we believe, as we're invested, we are along the ride with our investors. So we care about the journey. We care about, how we get from point A to point B over time. And so a big part of our process, and we'll talk a bit more about this in a minute, is delivering alpha with much lower risk, lower beta, higher downside capture, those types of statistics, so we can deliver a much easier ride as we go through, as equity markets can experience periods of significant volatility, especially in some of the emerging markets. And so we believe that being invested alongside our clients will help drive those types of behaviors. The second thing is really just to deliver world-class performance. I mean, that's the only reason we exist. You can go out and buy the benchmark for free, essentially, at this point in time, a couple of basis points. And so our reason that we are here and the reason we have clients is because our goal is to deliver outperformance. And you'll see from our long-term track record, we have been able to deliver that on a longer-term basis. And so this next slide, this just gives you, I think, a good snapshot of what I was talking about a little bit earlier in terms of what we're trying to deliver. You can see here the panel on the left, 5-year alpha that we deliver, top quartile alpha on a 5-year basis consistently over time, going back to the inception of this particular strategy, which is our global strategy, but they all pretty much have a similar profile when we're looking at the performance. And we've outperformed 100% of the time on a 5-year basis, rolling 5-year basis, but we've done it with much less risk. You can see bottom quartile beta. If we were using standard deviation, that would be a very similar metric. Many of our clients prefer to look at beta, so we're looking at that in this particular chart. But you can see, beta kind of consistently much lower than our peer set in the bottom quartile, and delivering a lower beta than our benchmark over the rolling 5-year period. And I'll skip over some of this team and just get into maybe some of the more intricacies of our investment process. I want to stop on this page because I think, one of the things as we look to sort of deliver that lower risk profile, that what we are sort of quality investors. And I know a lot of folks use that term quality, and nobody comes and says we're not buying, we're buying, the junkiest stocks in the world. But our version of quality, what we view as quality, is a little bit nuanced in terms of how we define that, how we think about quality. And it's not that the metrics that we use, the types of companies that we look for, companies with high barriers to entry, companies with high free cash flow, companies that have defensible business models. It's really the fact that these aspects of quality can be temporal. They can be exhibited at times and they can be diminishing at times. And what we're trying to do is build a portfolio that emphasizes those factors of quality when they're being recognized by the marketplace, when they're being expressed by the company's business model, and then, then reduce those or sell out of those stocks that where those characteristics of quality are being diminished. And you can see the panel on the right, which is our sector allocations over time. This leads to a very dynamic portfolio, a very adaptive portfolio where we're looking to put capital to work, where we see that quality starting to be expressed. And so we call that forward-looking quality. We're looking to invest in companies, to use the whole tire analogy, I'm sure many of you heard it, we're looking to skate where the puck is going, not where it's come from. We're looking to emphasize those stocks in the portfolio and those businesses in the portfolio where quality is being expressed and going to be expressed, where we see those things developing within those business models. And it can lead to, it does lead to sometimes significant shifts in sector allocation in the portfolio. You can see the panel on the left shows the ranges within the sector allocations that we've had. You can see at times we've had very significant relative weights to a technology sector, and then we've had significant underweight. So we've been underweight or overweight almost all of the economic sectors at various periods of time, and that also is part of that forward-looking quality, because we have a slightly different definition of growth in terms of what we're looking for growth. As the palette for us is very wide. We believe in sort of looking to provide a double-digit total shareholder return over time. And what I mean by that is saying if we take dividends plus earnings per share growth, if we can get to a double-digit number there, if we can get, let's call it 10% for a line in the sand, if we can get dividends plus earnings per share growth rate at a double-digit rate, that's to us a growth business model. That to us is an applicable. I think there's a lot of growth managers out there that'll say, I have to have a significant overweight to technology or the traditional growth sectors because I'm a growth manager. We don't believe in that. Our process has a very wide. We have to look very far and wide for where we're finding this quality, and that can be in utilities, that can be in industrial, that can be in consumer staples at times, where we're finding those companies that are expressing their quality over time, and their opportunity set is very big. And you can see again on the right side where we've allocated a lot towards technology or energy, for example, where many growth managers have sort of left energy for dead, because and that obviously has been a mistake over the last 4 to 5 years since the COVID time period. And I'll talk a little bit more about how we've developed these theses over time and how that works. But suffice to say, this gives us a very wide berth in terms of which to allocate the portfolio over time. And maybe it would be helpful if I use an example of a company, over time. And I like to use Microsoft as an example, because if you look back over Microsoft, it's been around a long time, and its business model has changed over the years. But if you go back 10 years ago, I mean, it was a tough stock to own. I think value managers probably had to hold their nose to buy Microsoft. I mean, from 1999 to 2014, it had a negative total shareholder return. The stock it was arguably one of the lowest quality stocks out there. I had a bad management team who was mired up in very low growth and poor segments of the market. But then fast forward to the last 5 to 10 years, it's been one of the darlings of the growth market. It's been among the highest quality stocks. And so as this, it's a good example of a business model over time that's exhibited very, very high quality characteristics at time, but it's been a very low quality stock at time. And you want to be adaptable. You want to look at where the market's going and what are the factors that are actually leading into making that business and helping that business become a better business. Maybe it's a change in management team. Maybe it's industry dynamics that are changing. There's a lot of, there's a lot of things that can go in, but if you have that attitude that it's the same old Microsoft, or this is not a growth area of the market, so I'm not going to look there anymore. I don't have an energy analyst on my team because they're just not growth stocks to me. And that's not the way we think. We have a very open mind to where we find new ideas. And so, as I mentioned before, this is, one team, one dream. There's no sector analyst. If you think about, if I'm a Japanese industrial analyst, I'm going to find a Japanese industrial to put in the portfolios, whether it's a high or low quality stock, because that's all that I have in my quiver, if you will. If the only tool in my tool bag is a hammer, everything in the world looks like a nail. So we're trying to avoid those biases. We have a generalist team that looks far and wide at any sector of the world. They can go where their research takes them to find these great ideas. And let me give you a little sense for sort of how this plays out over a long period of time, where you can see, this is just the track record of the period, but you can see those periods of drawdowns, the significant drawdowns here we've shaded in yellow, where the market's experienced a fairly significant drawdown. We've outperformed in every single one of those. In fact, if you go back to Rajiv's longer term history, he's lived through more than almost a dozen bear markets throughout all of the different regions that he's invested in, both developed and emerging markets. And he's outperformed in every single one of them. His track record is 100% in terms of delivering value and outperforming in those market drawdowns. And you can imagine, if we were looking just at the emerging markets, there's some of those that have been greater than 50%. And so again, thinking about the ride, thinking about how we get from point A to point B is a very important part of our process. And we've done that, with much lower risk, and especially in those periods of drawdowns. We can look at some of the risk statistics on the next page, where if you draw the lens out from a 3-year rolling period, which actually is pretty good. We outperform the peer set in our universe performance, on the 3 and the 1 year periods, short periods of time. We don't advertise that we're going to outperform in every single one of them. That's a very difficult thing to do, and we would never say we would be able to do that. We don't even try to do that. Everything we do is, from a 3 to 5 year perspective, a longer term perspective. But then as you draw the lens out, our percentage and our probability of outperforming becomes much to 100% of the 5 year periods that I talked about before. But I think what's important is also on the left side of the panel there, where you look at some of those risk statistics: lower beta, lower standard deviation than the market. We capture a decent, part of the up market, but we tend to leave the party a little early. We tend to start to sell down and take some of those chips off the table when stocks have done well, reallocating that to arguably some of the more defensive areas, which translates to that downside capture that you can see of little over 76% of the down market capture, which is a very high number. That's a number that we're proud of, a number that that we want to continue to deliver. And if we do our job right, that's hopefully something that we can continue to do throughout the future. And this is just a longer term. I know I'm going through this pretty fast, but I want to get to something that's probably the most interesting in terms of our portfolio. Composition here, and we've got, we show the top 10 stocks on the left side, and then our sector allocation and some of the more characteristics and where we are in the world, because I do want to talk a little bit about emerging markets as well, even though this tends to. And this portfolio, as you can see, does have emerging markets exposure. We use an all country world index benchmark. So we do include emerging markets in India. You can see India on there, and Brazil are areas we're finding good opportunities. We're also finding good opportunities in the UAE, where I'm sitting now today in Abu Dhabi. We're excited about the economic growth that they're experiencing here, and some very well-run companies that we're able to make investments in. It doesn't have the depth, of many other markets in the emerging market space at this point, but I think that's going to be changing as they're opening up their economies over the next several years. But if we look at the portfolio now, especially relative to where we were maybe a year ago, we had a much more significant overweight to technology. I would say at this time last year, we were significantly overweight technology, exiting the second quarter, and then we saw these stocks that did quite well. Obviously AI, and just the natural technology cycle was playing out, and these stocks have done really, really well. But we started to see some cracks in the dam as we passed through, the first quarter earnings period. We saw ASML and we saw some of the semi-cap equipment companies start to falter a little bit, start to push back some of their orders. Concerns maybe the Chinese were over ordering in some of their chips in advance of and some of the equipment in advance of future sanctions. And so we started to trim back over the course of the summer across the board in technology and some of the tech-like things in the consumer, the communication services sector. Just because of the fact that these had done really well, but also we started to believe that there's been some over earning here, and it just got less visibility in the earnings on a go-forward basis. That turned out to be right on one hand, but not so right on the other, as the AI phenomenon continued to play out over the second half of the year. And so as having an underweight to technology wasn't helpful in terms of the technology space. And so we've brought that back a little bit in terms of, but what we're doing is sort of keeping it on a very short leash as we've seen just over the last 48 hours in terms of the news that came out over DeepSeek that may be changing the landscape a little bit, because and leading to a little more cloudiness in terms of the AI spending and the data center build out, because we see a model that's very efficient. If there's sort of two takeaways that we can look at at this point in time, are really one, that lead to sort of the democratization of artificial intelligence. It's the fact that this model is much more efficient than what other models, especially ones that are been created in the US. And it was almost forced upon the Chinese to develop a model like that, because they didn't have access to the leading edge chips, and so they were forced to work with what they had. They had NVIDIA H800s, which are much less much slower and less computationally efficient. And so they were forced to create this model that was much more efficient. And so almost like the sanctions actually backfired in terms of what actually happened. And so we have a much more efficient model, but then we also have an open source model, which is different. If people remember going back to OpenAI actually was open source at its infancy, and now it's a closed model. But that can lead to much more app development, and when you have an open source model, it's much easier to make it adapted to what you're trying to do in the specific use case for your AI. And so we do see, I wouldn't characterize it as a seminal shift in the moment of artificial intelligence, but clearly a data point on the journey. And we've been skeptical of this, as there always has been in our minds a limit to the spending that was going to happen. Maybe we're seeing that start to materialize now. We haven't heard a lot of information from the tech companies, but we do see that this is a significant data point along this journey, and we're looking at that closely in terms of what the implications could be over the next 6 months to the next year, in terms of if spending does start to get reduced, or maybe it will change into a little bit different direction. We'll see how that plays out, but that's how we're thinking about it. I would say overall, we've broadened out our portfolio and as I mentioned, taken down some of the bets. We still like healthcare. We really like some of the pharma companies. You can see Eli Lilly on there. This GLP-1 phenomenon, which continues to play out. And, unfortunately, we've seen some volatility with a company like Eli Lilly and also Novo Nordisk, which is another holding that you can see on this page. Those companies are really on the cusp of this massive move. I mean, we're talking about a 50 billion market now for GLP-1s, and some of the conservative estimates I've seen out there are kind of in the $150 billion range. So maybe it's higher, maybe it's a little bit lower, but suffice to say, it's going to be a significantly bigger market in 2030 than it is now. And we've just scratched the surface on treating obesity with these treatments. Right now, most of the prescriptions are being written for diabetes. And the obesity market globally is very, very big. Not to use a pun there, but it's a very large market and a growing market. Unfortunately, that is the case. But these drugs treat a lot of the comorbidities that go along. So not just obesity, but all of the things that that go along with obesity, such as heart disease, prediabetes, cardiovascular diseases. And so we do think that, despite the volatility, despite the fact they've had some issues with their supply chain, they're working on those things. Those have caused volatility into their stocks, but we feel very excited about the long-term opportunity there. We still have exposure to technology, albeit at a much lower rate. But we've also been finding good opportunities in places like utilities, and not just kind of the utilities that we've had in India, where you have secular growth stories there, very well-run, reliable utility companies, but also in the US, where the data center and the electrification of the world has led to significant power demand. And quite honestly, in the US, it's a very dated grid, and it needs to have a lot of upgrades. And the regulators have realized this, and they're relaxing their constraints on some of these companies. And so we look to areas where there's favorable regulatory environments to be able to invest, where they can actually earn a good return and get to that that double-digit total shareholder return that I talked about a little bit earlier. So we're finding good opportunities there. Let me take a second and just talk about emerging markets, because actually Rajiv and the team is pretty excited about emerging markets at this point in time. I think there's been a lot of clouds around many of the countries, India and Brazil in particular, where we're actually still quite excited with the fundamentals of the business and the ongoing development, especially in India, where we see continued infrastructure build out and continued investment. And really the country's trying to become the alternative to China for manufacturing, and they have a mandate there. And so they've passed a mountain of reforms over the last decade or so that are allowing companies to be profitable. And they're seeing the fruits of that now as these companies are going in and getting projects done. They built Adani companies, which is part of our holdings there, and which has had some controversy over time, but fundamentally the company has been executing very well. They built the second airport, or the tertiary airport in Mumbai in a year. I mean, that's unheard of in any developed market. They had the first plane that's already landed there, and they built it in less than a year. And India has a very under-penetrated air travel market. And so we're very excited about airports in India. We're very excited about infrastructure growth, be it power, be it ports, be it, just all of the things that feed into the phenomenon there that's happening. And the market has been under a little bit of pressure recently, as it's been used as a funding source as foreign investors have moved out of India and into China. We think that's starting to slow now. And in fact, we've had seen a lot of domestic buying in India, which has offset some of that foreign outflows. Otherwise, it probably would have been a lot worse in India. But unfortunately, they have a lot of domestic internal buying to offset the foreign investors that have been taking money out of there. But suffice to say, we're still excited about India. All of the things that are sort of underpin in terms of the infrastructure, the things that are happening there are still intact, despite there's been a little bit of cloud. So be it banks. We have avoided some of this sort of, what many people would consider as the yesteryear's winners in India, some of the consumer staples companies, so like a Hindustan Unilever, which again are still good companies. They're still doing okay, but if they're trading at 50 times earnings for single-digit growth, that to us is not so much of an exciting opportunity, because valuation is obviously very important. We're very cognizant of what we're going to pay for growth. We're not going to pay anything for growth. We need to see the earnings growth, but we also don't want to overpay for it. And so there are areas where things have gotten a little frothy in India, and we're avoiding some of those areas. We're finding different opportunities that may not be trading at such higher valuations. Also in Brazil, a very similar story, where you've had a lot of headwinds. You've had a new administrator, or not really new anymore, but the Lula administration is in place, and Lula tends to talk a big progressive game, and his bark seems to be much bigger than his bite. But when it comes down to actually passing policy, he has been somewhat pragmatic. He hasn't really done a lot of damage to the economy, although they are starting to see a little bit more fiscal deficit. They can deal with that. In fact, some of the banks are doing quite well. They're raising their loan guidance. We haven't seen a lot of growth in their loss provisioning. And so fundamentally, these banks are doing quite well, and they're very adept at managing interest rate cycles. They can be very profitable throughout the cycle. And banks tend to be bellwethers for the economy, and they're still quite strong. Even though the stock prices have suffered a little bit over the course of last year, they are actually doing pretty well on a fundamental basis. as well as a company like Petrobras, which is a large holding for us. And Lula's been talking about changes and things that he wants to do to Petrobras, but really hasn't been able to implement any of those things. It's got some of the highest quality assets in the pre-salt layer in terms of oil and gas exploration in the world. It's a well-run company. It pays a 15% dividend, trades at 15 times free cash flow. So because it's part of Brazil, it tends to be, they tend to trade at a discount, which we quite like, and we'll pay for that. So, I mean, it trades at about a third the market cap of a company like Chevron and has almost exactly the same free cash flow. So I'll stop there. Again, I've said a lot and go through that, and maybe I'll just turn it back over to you, Eugene, and see if there's any questions.
Kevin, great insights to your fund, and clearly, you're not afraid or scared to take profits if you need to move on to another opportunity in your portfolio, and it shows in your historic performance as well. Great outperformance, low volatility. One quick question in a minute. I'm very much aware that we're out of time. China, FOMO, especially the H shares, massive recovery towards the end of 2024. You've got zero China exposure. I know Rajiv Jain also did a presentation, I think, middle last year, specifically focusing on your EM fund. No China, very much into India, which you've explained about. Just talk us through China. Why no China?
Sure, yeah. So we don't have any China exposure in this fund, and we have been significantly underweight China in our emerging markets fund.
Yeah.
And it's a combination of really just why I would say a combination of things. One, obviously the economy has struggled, but also it's just the earnings. I mean, if you look at the relative earnings of, say, in India versus China, it's dramatic in terms of the company's ability and the attitude that that the Indian government has taken and towards and allowing companies to actually be profitable and make earnings, where it seems like China has been cracking down on, if you do too well, you get cracked down, you become part of common prosperity. So we haven't really seen, despite the fact in the incredible growth in the economy over the last decade plus, we haven't seen that, we haven't seen a consistent level of earnings. We haven't seen a corresponding level of earnings throughout China. And so that's the stance we've taken. We've been underweight since 2021 in our emerging market strategy. We continue to have an underweight, albeit, and we always want to caveat things with, we are less bearish than we were a year ago when, we've seen obviously some stimulus come through. We've seen, some things that the Chinese government have done maybe taking hold, although we're still seeing sort of the property bubble play out, and we're still seeing property prices go down. So we still have a lot of concerns there, but we're at the margin getting a little less bearish. So we have incrementally dipped our toe back into some of the e-commerce areas of the commerce. The exposure that we had prior was more in commodities companies. PetroChina actually has done quite well, and some other state-owned enterprises. That's one thing that we are comfortable investing in, state-owned enterprises, when we can see that the company is, we can see visibility of earnings, we can see the company management team is focused on on earnings. And so we're comfortable taking positions in companies like Petrobras or PetroChina or state-owned enterprises when it makes sense. In fact, some of the best, most well-run banks in the world are Indian SOE banks. And so, or even some of the Brazilian banks, for example. And so we're a firm that will go into state-owned enterprises, and some of those have done quite well. Some of the mining companies in China have done quite well. And so we have found opportunities in China. We're starting, and valuations obviously are very attractive there. And so we're starting to maybe just dip our toe back into some of the areas that we've been avoiding for the last 3 or 4 years.
Very interesting indeed. Kevin, the clock caught us. Thank you so much for coming on this morning all the way from Abu Dhabi. We're really grateful to our audience here in South Africa. If you're looking for the GQG funds, they are represented by Southern Right Capital as a partner in SA. So the two funds, the Global Equity and Emerging Markets Fund, has the acronym Southern Right Capital in front of the funds. If you don't know where to find it, give us a shout and we'll get you in touch with the team. Kevin, again, thank you so much.
Thank you so much, Eugene. Bye now.
Great stuff. And moving on very quickly and patiently, waiting on the other end, Nick Dennis from Anchor Capital. Nick, again, thank you so much for joining us. Apologies for keeping you waiting. You had a phenomenal 2024 in your global equity fund. But what can clients expect from 2025, and where do you see the opportunities?
Thanks for the intro, Eugene. So I'm going to start with a bit of a somber note and say I'm going to talk about what investors should worry about in 2025. And I'll kick off with this quote by the legendary value investor Bill Miller. When someone asked him what he worries about in the market, he said, and it's a bit of a flippant answer, but it contains a pearl of wisdom. And he said the answer is usually nothing, because everyone else in the market spends an inordinate amount of time worrying. And so all the relevant worries seem to be covered. So I have no ability to forecast the future. Nobody does. But what I like to do is see where the consensus is. What are the consensus bullish and bearish arguments? And the logic with that is, if everyone is positioned one way, then there's opportunities potentially looking another direction. So if everyone in the world, every man, woman, and child holds 100% of their portfolio in Apple, Apple probably isn't going to do that well. And this is not an exercise in blind contrarianism. If everyone on this webinar says, look, we think newspapers are going out of business because of the internet, it would be stupid of me to say, well, then I'm going to buy newspaper stocks because everyone, just as blind contrarianism. So it's not that, but it's a kind of a thought-provoking exercise. So one way to get the consensus and see where the consensus is to follow every year in January, Barron's publication has a roundtable event with a bunch of sort of well-known investors. And I pulled together what some of the bullish and bearish consensus arguments, the themes that keep popping up. And so on the bullish side, and it's really in the wake of Trump's victory, the panelists, they expect a strong US economy. They, looking for double-digit earnings per share growth in the S&P 500. The Trump story, deregulation, M&A should pick up big time. And then, obviously the AI theme. On the bearish side, they're negative on rising bond yields, and you can also you can add in the dollar with that. That's very much a consensus view. The inflation story, they're also worried about tariffs leading to higher inflation. Valuations, high valuations is a concern mentioned by the panelists, and it's something I hear all the time. And so I'm gonna sort of talk about that some more. The government debt story, that's something that, that's waxes and wanes, but people are particularly worried about that now. And then policy uncertainty, obviously, with the new administration, and what does that mean for, geopolitics and the whole host of, government policies. But for now, I'm going to focus on high valuations, because this is one that just I hear so often. And when I talk about it, I'm certainly not throwing shade on anyone, and this is just my perspective and my view. So I think people talk about the high valuations in the US market, maybe in absolute terms and relative to history, and relative to the rest of the world. So I think it's really largely justified. And if you think about the sort of market concentration angle of that, is the biggest and best companies are a bigger and bigger part of the indices. But what's really important is that the quality of the top 10 companies and the quality of the best companies and the biggest companies has really improved dramatically over time. And so you can look at that in terms of their margins, their free cash flow, yield as a percentage of revenue, their returns on invested capital. It's all of those metrics have improved dramatically, not just over the past 10 or 20 years, but it's really improved over the past 70 odd years. So, now your best companies are, to a large extent, they're software companies, platform companies, IP companies. Whereas, 10, 20, 30 years ago, there was a lot more oil, energy, materials, industrials, financials, just lower quality, lower margin, more cyclical businesses. And the other reason why, this bleeds partly into valuation, but also just in terms of the relative performance of the US versus the rest of the world, is those amazing companies have also just grown faster. They've grown their earnings per share a lot quicker in the US, which is the dark blue line, relative to the rest of the world. So that's, this is not just a re-rating story. There really is something happening beneath the surface. And a big part of that is really a technology story, where the US has much greater representation in the indices relative to the rest of the world. And then it's a technology story, but then also to a large extent, if you look at the chart on the right, it's really also a Mag 7 story. So the Mag 7, they have got all the headlines over the past couple of years, but it is for good reason. It's not just because investors are a bunch of idiots and chasing the latest thing. So a line that I hear really all the time is, look, we all know the US is expensive and tech is very expensive, and these mega cap are expensive. It's like, we don't even need to check, we just know this. If you peel below the surface, it's not, and even if you pull all of that other stuff aside, I mean, certainly there are pockets that are expensive. I wouldn't be a buyer, but there's a lot of things that look really reasonable to me. And so, for example, I use the example here of Meta, which trades on 24 times. And then you compare that with more stodgy staples businesses like Walmart and Costco. So Walmart trades, it's like a third more expensive than Meta. And Costco is double the valuation. Now, you could argue that Costco is too expensive. I mean, I think it's too expensive, but I thought that a year ago and it went up 40%. And so someone's willing to bid that up. So let's have this conversation about Meta being expensive when it trades on 50 times. And even for the case of Costco, I mean, there are people that would argue that, look, it's like a bond that can grow its coupons at inflation plus almost indefinitely. And so they would pay 50 times for that. And you can use some of those same arguments for Meta. So you look at Meta on 24 times, Google on 21, even Amazon on 32 times relative to its 5-year average of 40 odd. Like, to me, would I prefer to buy these at single-digit multiples? Yeah, obviously, but we're not at the bottom of a crisis. So you have to play the hand that's dealt. And essentially, relative to everything else, given their quality, given their growth, given their market dominance, that looks quite attractive to me. And then probably everything that I've said about valuation thus far is essentially moot. And why is that the case? And in terms of thinking about what the market might return over the next year, well, it's because there is zero correlation between starting valuation and your return over the next year. Some evidence over 10 years or longer periods, even there are some sort of flaws in the methodology there, but let's say, what does this tell us about the year ahead? Essentially nothing. So, I mean, to use this, I really like this quote from Steve Cohen, who's a legendary trader. He said, everyone has a calculator, math is not an edge. So if you say, well, the market's dangerous because, or returns are going to be bad because it's on 20 odd times, whatever, there's no extra information in that. Like, everyone knows. So it's not good or bad, put it that way. So it's not something from my perspective to worry about in and of itself. I mean, so all of that said, trying to frame expectations for what we might see this year, there's all sorts of stats. I've just chosen one, which shows that typically the third year of a bull market in the US, returns tend to be relatively modest. So on average, they've been about 2% in the year. You can look at other studies like the first year of a presidential cycle. It just gives you a feel. It's certainly not predictive, just gives you a feel. So, returns could be significantly better than this, but let's just, I think it's probably useful just to go into the year with really, you don't need to be bearish, but just have realistic expectations. Don't go into the year expecting a 20% year. If you go in with modest expectations, I think hopefully you're surprised positively. And then just to add to that, I think it makes sense to expect volatility. So the average intra-year drawdown in the S&P 500 is about 14.5%. Now, obviously, that'll include your major bear markets where you've had 30-40% declines. In a more normal kind of more normal sort of non-recessionary, non-crash environment, the fall declines tend to be about 10% roughly. So, I mean, I think it makes sense to expect one or more declines of 10% this year, and that wouldn't be unusual. It's not like, even though at the time the media is going to be screaming blind about it, and it's the end of the world, this is the big one, it's the next global financial crisis, like odds are it probably won't be. So turning attention really more to the kind of the nearer term, sort of look at measures of sentiment, measures of positioning. Things got very, very heated kind of post the election by mid-December. Sentiment was very extended, so was positioning. And then coming into this year, in the first few weeks, actually that pulled back quite a bit. And just literally from 2 days ago, CNN runs a fear and greed poll, and I track a bunch of other sentiment indicators, but it's on the kind of the fear level. So that suggests to me, and then there's others, positioning indicators that suggest maybe not fear, but sort of more kind of negative to neutral kind of territory. And so sentiment positioning are, I would say, a modest tailwind over kind of the near term. It's certainly not like the case that everyone is over their skis as we stand here today. But the chart on the right was from the Bank of America's fund manager survey, which showed that fund managers' cash levels had really dropped to very low levels. And so that does give me a bit of pause. That's a bit of an orange flag at the moment. So I look at these things at weight of the evidence kind of basis. You need to see a bunch of these things line up to really adjust your stance. But I mean, so I would say, you know, these indicators suggest sort of some tailwind over the near term. But I think, you know, given that, you know, investor sentiment is kind of muted. I think the fundamental, actually, the on the ground sentiment among business people in America, you know, the regular citizens, I think it's, you know, the vibes I get are quite positive. And I think you look at the picture from Trump's inauguration, there were a lot of business people, high profile tech CEOs and founders there. And so it's really, really encouraging to me. Whereas the previous administration had a really adversarial relationship with business and with tech in particular, I think the current administration is going to really work with them, and that is a sea change, and that's really positive. And on the right-hand chart, you can see that small business owners suddenly became like a lot more optimistic. You know, part of that may be that, you know, that demographic leans towards more Republicans, so there's certainly some inherent political bias there. But more generally, the CEOs, what's coming from CEOs in the US, they're a lot more optimistic. They see regulations coming down. And so put all of this together, and I think there's a real scenario that animal spirits could be unleashed, both in the real economy and in the stock market. I think things could have the potential to get really quite hot. I'm going to speak very briefly on DeepSeek. A whole host of takes have come out. These are just my sort of high-level thoughts. Firstly, I don't think it's necessarily bearish for US tech. I think it's going to be very, very bullish for AI adoption, just bringing down the cost of getting these models out, massively bringing down the cost of inference. So it's going to make it far more accessible to small businesses and regular consumers. So I think it's very bullish. As we saw on Monday, but then there was a bounce yesterday. It could signal a shift. There could be a shift from the kind of picks and shovels infrastructure names to really the users of AI. As you know, in all of this, it's early days, and we need to see how this plays out. One word that just popped up all over the place on Monday, but which one phrase I'm very sympathetic to, is this idea of Jevons paradox, where as you bring the price of something down, it enables consumption to go up massively. So let's say first light bulb cost $10. And then the price of the light bulb went down from $10 to $1. I mean, families didn't just say, oh, this is great. We can have this one single light bulb in the house, and we can power, you know, and we can save ourselves 90%. No, what happened was, or the same in a factory or wherever. No, what happened is they first increased it they bought 10 light bulbs, and then 100, and then 1,000, and then we had electricity everywhere. So I think we'll see the same happening, and you can think of what that means for the implications of the guys that make the chips. So you think of someone like NVIDIA, but I don't know how that's gonna play out, and what the path there is gonna look like. Whether because I think the hyperscalers will push back on NVIDIA and say, listen, there are cheaper solutions out there. You need to give us a better price. And so, but at the same time, I don't think they're going to cancel their Blackwell orders, the next generation chip this year. I don't know why they would. And so there's just going to be all sorts of dynamics, whether maybe it's negative for NVIDIA in the 12 months, but maybe it's really bullish for them over 3 years. We're going to have to see. And then on a name like AMD, maybe this starts to give them a toehold into the market where it was previously purely an NVIDIA dominated market. So we need to see. I think what's fascinating to me about DeepSeek and the analogy that I think of is what my understanding of it is what DeepSeek did is they took a Toyota Camry equivalent and they optimized it and they turned it into a BMW in terms of performance. So then in terms of, does the analogy hold, and can Meta, OpenAI, etc., kind of use the same ideas and optimizations to turn a BMW into a Ferrari? I mean, that's what remains to be seen, and I think that's one of the exciting things. In all of this, I think the hyperscalers, so that's the major cloud companies, and that'll be the Google, probably Microsoft, although their relationship with OpenAI makes things a bit unclear. Amazon, like, you know, even someone like Meta. I think so many more of these models are going to be hosted through on their cloud. Like, I think it's bullish for them. I think it's bullish for them. Software, for the other users of AI, it should be bullish. Like it'll make Amazon's retail business better. It'll make Meta's algorithms better, content better, better products and cheaper products for content creators, advertisers. I think it's good. I think it's good. Software, it's still unclear. There'll be some winners, some losers, and we need to see. And then this week is going to be quite important because we'll get more clues from the hyperscalers in terms of what they're doing with their capex. We'll need to see if they want to put more pressure on NVIDIA. They'll say something like, "Look, we're gonna maintain our capex budget, but you know these new developments are making us rethink things." And but we'll see. It's fascinating. It's going to be fascinating to watch. So in terms of my kind of concluding thoughts, you know, to go back to Bill Miller, if everyone is talking about something, you probably don't need to spend that much time worrying about it because arguably it's largely baked into the price. I think one of those things is the valuation story. And I've just come across this my entire career. People are always worried. When we're not worried about the end of the world, we're worried about valuation. So you really just have to pick your poison. So even though I'm saying like don't worry about valuations, I still think it makes sense to have really realistic expectations about the market returns this year, as well as the volatility that we're going to see at some point in the year. And if we see something that's better than that, then that's great. And one of the scenarios where I think we could see better than that is this real animal spirits gets going in both the economy and in the stock market. I don't think we're there, but we could get there, and that would be a positive upside surprise. It's one of these kind of intangible things that you know, you can't model. You just know when you see it. And then, as I mentioned, there's sort of consensus arguments around the dollar and bond yields, and to the extent that we get some relief from those things, I think obviously it'd be good for multinationals, international equities, and I think emerging markets. And then, you know, put all of these things together, and I think now clearly I'm talking in my book, and that's my job. But I think all of this is good for growth companies. It's not a negative environment for growth companies, and so that's reflected in the fund's top 10. You know, you've got international emerging market equities like Mercado Libre and C in there. Plus some of the hyperscaler names. I've also just put an arrow next to NVIDIA. So what I've done, post DeepSeek is I had a bigger position, but I've actually just taken that back closer to the benchmark weight because I can make arguments both ways, and I don't know. So I need more information to work from. And so, if I land on probably this is going to look negative for NVIDIA for this foreseeable future, look to reduce the position or cut it entirely. And if it's opposite, actually, if this is a massive accelerator for them, then increase the position. But for me, it's important to manage risk first, particularly when you don't know and you don't have an edge. So that's the stance that I've taken. And then just to end with a quote from Morgan Housel, who's a brilliant writer, is just, you always hear these, he says, optimism sounds like a sales pitch, pessimism sounds like someone trying to help you. And so I love that quote. And so what I'm saying today is choose optimism. It's a happier path. And with that, Eugene, I'll hand it back to you if there's any questions.
Nick, thank you so much for bringing some sanity and common sense back into conversations. So great to see that. Very short question for you. AI craze, everybody's saying it will increase productivity. I do agree with that. But will that translate into stronger earnings of these companies and higher prices?
Yeah, that would be my bet. Trying to remember, so literally this morning I was listening to a podcast, and they were quoting a company, and I don't think they named the company, where they'd held their employee costs flat over the past 18 months or 2 years, but their revenue's gone up 100% or 150%. I can't remember what the number is. And so I think the promise of, even when the GPUs were $100,000, or let's just take a number, you spend $100,000 on GPUs, and maybe that means you can replace a software engineer that costs you $500,000 in the US. So there is an ROI story there on the cost saving side. So never mind the revenue side. And then if we're saying, well, DeepSeek and these other innovations can drop that cost from $100,000 to $10,000, but you could still replace a software engineer for $500,000, then I think your return on invested capital equation is even more attractive. So the US corporates are just brilliant at doing more with less and wringing efficiencies out of the system, as was showed in that sort of initial chart with the margins have gone up over time. So like some of that surplus will go back to consumers. But then some of it they'll hold on to. I'm quite confident of. So yeah, I think it's pretty bullish for margins and earnings.
Nick, thank you so much. Your global equity fund on most platforms, like I said, they had a phenomenal 2024. Let's see what 2025 brings us at Anchor Capital. Thank you so much for joining us.
Thanks, Eugene. Cheers.
And the man patiently waiting as the last speaker of our session this morning. Sean, my apologies for keeping you waiting very, very long. The last, but definitely not the least, you also had a phenomenal 2024. You told us beginning of 2024 to go to look more towards value and towards refund, and you delivered on the goods for clients, massively so. You've heard all the stories of growth stocks and high quality stocks. Love to see your views on global value and the way you see the world. You're on mute, Sean. It's because I've been keeping you waiting so long. My apologies.
My apologies, Eugene. Well, listen, thanks very much for the opportunity to speak to you all, and for your attendees attending this. And great, lovely quote from Nick there. Morgan Housel is one of my favorite authors. If anybody hasn't read those books, they're just brilliant. And I'm pleased to say that we're very optimistic. So, right, let's crack on. So I'm assuming you can see my slides okay. And we're all good. So let's just have a look here. This is the MSCI World Index regional weighting. And this is what you can see in North America, 76%. And that's comprised 73% US, 3% Canada. Europe starts 16, Japan's down at sort of 4, not much in Asia, nothing in emerging markets. And what you can see is it's just massively skewed. Now, this is nothing, you don't know, but it really is just shows you it's quite stark to look at just how outsized North American weighting is in the index, and because of that, in many portfolios out there. And why is that? Well, obviously the US has done phenomenally well, and this is the S&P 500 total return index, and it's gone up from roughly 1,500 to almost 13,000 since bottom of the market in 2009, just before 2009. And really what I want to do here is disaggregate that and say, where do our returns come from? And this is for a company, and this is for an index. And I think it's very important because, as Nick said, no one knows what the future is going to be. So we have to go on the odds basis. Where are the odds on our side? So what is the source of return? Well, for a company and for an index, a company's share price, there are three sources. There's earnings per share growth. There is the PE rating, so you either get multiple expansion or contraction, and dividends. And you might say, well, what about buyback? Because companies buy back. And that's really, if you're buying back shares, well, then you reduce the shares in issue, and that means your earnings per share growth should go up. Okay, so that is where our source of return comes from. And let's look at the S&P 500 total return since 2008 and break it down. So what you've seen is that the index has gone up 9 times, and that works out at 14.6% compounded. And if you break that down, nearly 7% has come from earnings growth. This is what the earnings per share for the index has done. So that's the earnings growth. You've had 5.3% per annum from the PE expansion, and that's because it went from 11.7 times earnings to 26.5 times earnings, and effectively you got 11.7 times earnings on 77, and then the earnings grew and you increased the re-rating, and so there's that compounding element there, and you got 2% from dividends, okay, because the price is lower. And so if you actually look at that, 48% of your source of return came from earnings per share, 37% from your rating, and 15% from your dividend yield. Okay, so that is the source of the return of the index over that period. And one of the things which has driven the rating has been these massive inflows into passive funds, because you've had, as Nick said, you've had a number of very fast growing technology companies, all the names we know. Those have become bigger in the index because interest rates were low and we could value that growth at higher PEs. And then to compound it and push it even further, after the good years, 2020 was a good year for tech investors. We're all sitting at home ordering stuff on Amazon or for our new Apple iPads. You saw massive flows, people chasing the good returns. 2022 was a disaster. And so what happened in 23? Not much relative to some of these historic flows. 23, good year for growth investors. What happened 24? You had about $1 trillion pouring into ETFs, and roughly half of that in the last quarter following Trump's election. So you've had these huge inflows, and what that's done is that's contributed to the re-rating. Okay, but the problem is it's not 2008, not 2009. So how do we gauge what we can get from here? Well, let's just put some of these things into perspective. This is the S&P 500 price earnings ratio, and it's a historic multiple because no one knows what the future is going to be. And the future is very different for NVIDIA from what it was a week ago. And what you can see here is that we have a historic PE multiple of around 27.5 times. And what you've got here, the green bar is the average going back to 1990. And these dashed blue lines are 1 standard deviation and then 2 standard deviations away from the mean. So you've got 27 times earnings, which is closing in on 2 standard deviations away from the mean. But you're coming off a base of 2008. So you saw the PE rating, the contribution, the meaningful contribution, but that is taking it from a 2 standard deviation below the mean to almost 2 standard deviations above the mean. Okay, so the question is, if you think you're going to get a lot of your return going forward from a further re-rating, well, you've got to expect it to be quite special and unique and not and not based on what the historical experience has been, especially with interest rates being much higher now, because you can effectively get almost 4.5% risk-free in government bonds. How much risk do you want to take by buying tech companies on low free cash flow yields? So that's on the re-rating. What about the earnings contribution? Well, here what we have is we have the profit margins, okay, for the S&P 500, and you can see it went from below 4% to above 10%. And so you've had an increase in profit margins. Now, lots of that has been driven from efficiencies and technology and squeezing more out of the process and etc. And you've had these, margin expansion. So, but again, you've had that. Do we really want to expect profit margins increasing substantially? Well, you can make the case for technology improving, and AI is going to improve profit margins. And I made the case, I think, a year ago that actually AI, a great way to play AI is with a value strategy, because you want companies with big cost bases, because the cost bases, then AI has got lots to work on, and you can increase the profit margin. So yes, I'm sure some profit margin growth, there could be growth, but one needs to be mindful of the fact that you're already playing against the odds with profit margins being high already. And one needs to also bear in mind that included in this are the super profits that NVIDIA is making. The super profits that maybe they won't be making going forward if people are buying the cheaper chips. Super profits that Apple's been making. Well, Apple's sales are down 18% in the first quarter in China, which is their second largest market. And so one's just got to bear in mind that actually expecting profit margins to increase massively from here is quite a call. Okay, and if you look at the IT sector, this is the price earnings ratio at 42 times. You're over 2 standard deviations above the mean. Okay, so in terms of what's the outlook, well, margin's already high, PE is already high, and your dividend yield's lower. And so I completely agree with Nick and some of the other speakers that the US is expensive. It's a tough place to start, and expecting historic returns to continue from here, it can happen, but it's unlikely. Okay. And I think one also needs to bear in mind that derating can happen even though earnings grow. And so what we've got here, just quite a real-time example, this is Novo Nordisk, and the white line is the share price. The blue line is the earnings per share estimates for 2023. And so you can see that, that's how they moved, and they got to end of 23, and that's where they ended. All right, the orange line is 2025. And so you can see that, people, because it's a higher number, people are expecting growth. And so the share price has been rising because the outlook for growth has been very favorable. We've got an obese population and everyone wants to take these drugs, Wegovy and Ozempic and all the rest. And it's a 2-horse race at the moment. There's 107 products in development. But what happened late last year is estimates started for 2025, just started tailing off a little bit. Okay, they didn't collapse. You still got growth over 2023. They just started tailing off a little bit. And what did that lead to? It led to a 40% fall in the share price, even though you're still expecting earnings growth. And the rating went from 40 times earnings to 22 times, back to its long-term average. And so the point I want to make here is that, you might say, well, these are wonderful companies, they're still going to grow earnings. Absolutely. But if the earnings estimates just slow, the earnings growth expectations just slow a little bit, okay, you can get some very sharp falls in share prices. And so we just need to bear that in mind. And this is a very similar chart. Thank you, JP Morgan. There's a fantastic guide to the markets that they put out every month. And please go and have a look. There's lots of wonderful charts. And what we've got here is the S&P 500 forward PE ratio and subsequent 1-year returns. So you've got on the x-axis, you've got the forward PE. And on the y-axis, you have subsequent returns. And you can see that even if you pay a low PE, tells you nothing about what the earnings, what the share price growth or the S&P index can do, the return for the following year. Over a short period, tells you nothing. But over 10 years, tells you quite a lot. Okay? So this is where we are. And what does that show you? It shows you that the less you pay, the lower the PE that you pay, okay, your starting PE, the higher the subsequent returns. And that just basically says exactly what we've been saying, that the starting point of the PE is very important, and so valuations matter. Now, if valuations matter, well, where's the value today? And what we've got here, this is again, thank you, JP Morgan. What you've got here is the PE ratio, forward PE ratio on the y-axis. The green horizontal bars are the average since 1990, and the blue squares is where the multiple is today. And so you can see in the US, the forward PE is much higher than the average, and because the US is so big in the index, that's dragged up the forward multiple for the index. But if you look elsewhere, Europe ex-UK, UK, emerging markets, China, well below average. So your starting point is at a far lower point. It just means that the odds are in your side that there could be a re-rating if there's some earnings growth, etc. And so that's how we positioned. We have more in Hong Kong than we have in the US. And that shouldn't surprise investors. We don't really worry about the benchmark. People can invest. We're not trying to chase the benchmark. We're going to invest in sensible companies, great companies at sensible prices, and the benchmark must do what the benchmark's going to do. And we also have been in this long enough to know that benchmarks don't only go up, benchmarks fall. We just haven't seen much of that. Well, we saw it in 2022, and it never feels good performing in line with a falling benchmark. So that's how we position. We like to think we're more evenly positioned, but it should be no surprise. Emerging markets, Asia, Japan, Europe, all in great companies, we think, at low prices. And this is a fantastic chart off Morningstar, and I encourage people to use Morningstar. It's a wonderful resource. And what you can see is the valuation metrics of our portfolio, 7.5 times versus the index. This is the Morningstar Global All Cap, lower price to book, higher dividend yield, etc. So much cheaper than the index. But then are we buying worse companies? Well, if you look at Morningstar's data, the historical earnings growth for our portfolio of companies has actually been higher than the index. The sales growth, the cash flow growth, the book value growth has all been higher. Okay, the long-term earnings outlook apparently is low for our portfolio, but only marginally, and we know that forecasting is very difficult. And so we don't pay a huge amount of emphasis on growth, on forecasting growth. That can change. And so if you look at the outlook and you say, well, if there's earnings growth of roughly 8% according to the Morningstar data versus 10%, but the PE is so much lower and the dividends are much higher, that's why we're optimistic. Coming back to Morgan Housel, we're optimistic about our potential, the fund. And the other important point is just relative to all our peers, because we have such a differently positioned portfolio, we have much lower correlation. And just to give you an idea, a couple of days ago when the market was falling in a heap because of this NVIDIA, our fund was up. So, up 1% in absolute returns. 2% relative. And so that just means that in a portfolio, if you've got some of the go-go portfolios blended with us, it just gives the clients a slightly smoother ride. And then this is the style matrix, again, off Morningstar. You can see where we are over here, mid-cap value, very different for where the larger companies are, larger portfolios are, large cap growth, typically. All right, just in terms of DeepSeek, is it DeepSeek or deep trouble? Well, I think it's terrible. We think it's terrible for hardware companies, and one needs to bear in mind there's $6 trillion of market cap if people are starting to pay far less for the chips. There's some negotiated and already agreed CapEx spend. Yeah, we'll have to, that's going to be in the price, but are those companies going to get a return on investment is the key thing. And also, just a warning for many of these themes, investors, it's much easier to fall in love with themes. And one of the themes has been, well, these guys are going to be using so much energy. What we need to do is go buy the utilities, go and buy the cable companies and the electricity gadget providing companies, the Schneider Electrics and Siemens Energy, some of the worst performers on Monday were those companies, because all of a sudden it called into question those themes. Of course, it's potentially good for users of AI. It lowers the cost. Well, that's wonderful for our companies, like banks that are using AI extensively. And I think just hot off the press, we haven't seen too much, but last night, Alibaba announced their AI model, Qwen 2.5, actually beats DeepSeek. So, we mustn't think that DeepSeek is the only company out there trying to do what and extract some of the value that the US AI companies. That's a wonderful thing about capitalism and competition. It attracts new competitors. No one's sitting out here. If you're in tech land, you are trying to get a piece of that AI lunch. You're not sitting around going, oh, I missed that wave. I think I'll catch the next one. And it calls into account technology valuations, we would argue, because if your business can be disrupted in such a short space of time, why do you want to pay 50 times earnings for those companies? Okay. And we actually think this is a fantastic catalyst. The catalyst has potentially finally arrived to drive some rotation into value. And you just could get some managers going, you know what, and family offices saying, I've got 72% in North America. Why don't I just take a few of those percentage points and allocate it to the rest of the world? Well, the liquidity in the rest of the world is far lower. And so it would not surprise us to see some fireworks as people try and take money out of those companies and put it elsewhere. And we actually have Alibaba and Baidu, both in our top 10 holdings currently, and well exposed to this. And just to to give you an idea, if you strip out the cash with Alibaba at the moment, you're paying roughly 170 billion. It generates around $20 billion of free cash flow a year. Palantir has a market cap or enterprise value of 178 billion, and it's forecast to make 1 billion, not 21. So this just shows you the valuation discrepancies available out there, and value investing is not just about buying boring old companies. We've got Alibaba and Baidu, and these guys, Quen 2.5 is supposedly better than OpenAI. So I'm not going to dwell on the returns. You can see the returns, yourselves. This is versus our value peers. We've taken 100 to almost 1,100. In terms of our offering, we don't have any segregated mandates. People have asked us to run multi-million-dollar seg mandates. The answer is no. Put the money in the fund for where everybody is, and that'll help lower our TER. And so that's what we want. And we're currently at $460 million. At $500 million, it's in our prospectus. Our management fee for the retail class goes from 0.9% to 0.75 above 500. And at above $1 billion, the management fee falls further. And we know these are scalable businesses. And as we grow, we want to pass on some of those benefits to our clients. We don't charge performance fees. And the institutional fee, which caps the TER at 1%, is available via the platform. So, that's our summary, really. Eugene, that's pretty much it. We're optimistic.
Sean, I think if this was a live audience, you would have seen a couple of giggles, including from my side as well. Very entertaining indeed, but thought-provoking more than anything else. And we can see from flows to your funds that the market tends to agree with you on where we are and where we should go. And in diversifying client portfolios. Maybe a quick question from the audience. If there is a re-rating, do you think that capital will get allocated to unloved US companies, or will they get reallocated to places like the UK and China?
Well, it's interesting because obviously there's this perception that China is very risky. And what about political risk? Well, we've got political risk here in the UK. We've got political risk. We've seen political risk in France, in Germany. I mean, I actually think there's huge political risk in the States because Donald Trump is unpredictable. And if you look at his recent actions, imposing tariffs against Canada and Mexico, well, they import agricultural products from Canada and wood from Canada, and we need to rebuild housing. So it is potentially inflationary. There was an Economist article 6 days ago which said the tariffs are usually inflationary. What they also do is they lower economic growth because it costs more. And so if it costs more, well, you got less money to spend on other stuff. Okay, so one of the things everybody's going on about the economic miracle that's been taking place in Argentina, well, one of the things that Milei did was lower tariffs, just remove them. And it's lowered costs, and people have done that. So, and it's driven economic growth, and it's driven surpluses, etc. And what's Trump doing? He's imposing tariffs. So I actually think there's huge risk that's not being priced in the States. And where the flow is going to go? Well, we've seen hot money come into the US that in those ETFs quite late in the day. And now those guys are underwater in many cases. I mean, you've got 4 times leveraged NVIDIA ETFs and semiconductor ETFs. Those guys are down 30% this week. So it's going to be determined by the flows. But effectively, if there's great value, value makes sense. We all want a good deal, so they'll flow.
And I mean, part of it, we did speak to that earlier in the session as well. Is carry trade. Cheap money going to the S&P 500, buying those ETFs, the top tech companies. What's going to happen if that thing starts to unwind further? And part of it sell off, as we got explained to you, was some of that carry trade to start to unwind again. So what's going to happen with the cheap money and where is it going to go? Again, Sean, like I said, very, very thought-provoking indeed. And if you do want to diversify away from all the expensive stuff, good reasoning behind it. Randmore Global Equity Value Feeder Fund we run on all the platforms, and truly not a benchmark hugger. Make the calls and make it right. Sean, thank you so much for joining us this morning. Apologies for keeping you waiting. It's been a real privilege to have you with us again. Thank you.
It's a pleasure. Thank you so much for the invitation. Bye-bye, everybody.
Dear audience, that brings us to a close. Very, very long session. And again, apologies from my side for taking a little bit more time. Big thank you to all the presenters for making for fantastic content again this morning. Quick reminder, next week, Wednesday, is our session 2. And we'll have managers on like Fundsmith, T. Rowe Price, Sands Capital, Investec, Fairtree, and Gens Global, a whole big mouthful. And we're going to take the conversations forward. If there's anything specific you would like to know, please send us the questions in advance or then ask next week, Wednesday. There's a couple of open questions on the panel. We'll try to get the feedback for you on those questions as well. The BCI team, Tanya, Olga, and the team, thank you so much for making for great content, great session again. And I'll speak to you next week, Wednesday. Thank you.